This conference will now be recorded.
I guess witnesses weren't enough. We've actually got to have a recording to go with it. I hope everybody can hear me okay. I'm sorry I'm loud here. I don't, my voice doesn't carry very well, so I'm trying to compensate for that. My name is Chris Murphy. I'm a certified public accountant with BKD. BKD is a large national accounting firm. Our Oklahoma practice has a pretty strong specialty in the healthcare space. And throughout the course of my career, I've been with the firm about 27, going on 28 years. And throughout the course of my career, I've worked exclusively with people that do healthcare. As an auditor, as a cost report preparer, as an operations and financial consultant, I've done a little bit of everything. The last about 20 years, I've focused almost all my energy on skilled nursing and senior services. So that's kind of my pedigree. I know that nobody looks at administrator school because you want to be a financial manager. If you wanted to be a financial manager, you would have gone down a different track, right? So my goal for our time together is to sort of make this as painless as possible, to sort of teach you enough financial management and enough techniques that you learn the language, that you understand the concepts, and I think maybe most importantly, that you have a fair amount of confidence that it's okay to ask questions and push back on your accountants. I will tell you, and I probably will say this again. In fact, I repeat a lot of the things that I say just because in saying things different ways and in different contexts, sometimes I find something resonates with somebody, makes more sense. But as a young auditor or an accountant, some of the hardest conversations I had to have and some of the best insight I've gotten in my career has been from non-financial background people, but who understood the link between their financial statements and operations. So they ask something about, I don't understand why X expense went up or why I've got this asset on my balance sheet. And when you go back and look at things based on their understanding of the operations, they actually have a point. So one of the things I want to do is to give you some confidence to push back and make sure that you know that not everybody, goes to bean counter school, right? And I just want to give you the confidence to push back and to know that it's okay to ask questions and to understand your financial statements. In fact, as you think about your performance, I mean, the education that you're getting right now, there's a broad spectrum of things that you're accountable for, right? You've got to be better than average in resident care. You've got to know survey qualifications. You've got to know all of the admissions, documentations, and screening. You've got to know enough about pharmacy to be good. You've got to deal with resident satisfaction and HR and family relationships and staff satisfaction and all of that stuff. Bottom line is financial performance is one of those pieces as well. And if your facility isn't performing well, or you want your facility to perform better, you've got to have an understanding of the reporting mechanism so that you can go in and make changes to your operations and see those changes bear themselves out in the financial statements. So with that, when I think about financial management, it's about understanding financial results first and foremost, and we're going to spend a fair amount of time on that. In fact, almost all of our time before our lunch break in about an hour and a half is going to be on sort of understanding some of the language of financial reporting, understanding what some financial reports look like. Part of your process of financial management is setting expectations. And then measuring against that. So that's a really fancy way of saying part of financial management is budgeting. And the budgeting process isn't just setting an expectation for what our financial performance is going to be next year around, right? It's measuring how we do against that financial performance. And when we don't do exactly, when there are variances between what we expected and what why do those differences exist, and being able to explain and understand those things. As I alluded to, making changes in your operations. And finally, understanding the financial impacts of management decisions. If we decide that we're going to use, I don't know about you guys, but what I'm hearing from a lot of my clients is that their clinical staff, their direct care staff are tired, right? Just worn out right now. And, you know, we're looking at thinking about decisions for how do we use contract labor to stabilize our workforce. If we're going to use contract labor to do that, we've got to understand what do we spend on that? And if we can reduce turnover, what do we save? You can't just make those decisions without considering the financial impact, right? So being able to think through all the way to the end, this is what would be best for patient care or best for staff satisfaction or staff retention, but we have to know the financial impact of that too. So being able to think of that. All right, so I will tell you, my first 2 semesters of accounting classes did not go very well. It was like, and I say that to say I understand sort of that was my life's work. That's what I'd chosen to do with my career. I declared a major in my first semester and stuck with accounting all the way through and managed to turn it around. But I say that to say I understand that some of the concepts here are a little foreign or a lot foreign. Some of the definitions and vocabulary are going to be foreign and hard to get your mind around. So this is sort of repetitive by nature, but we're still going to do 2 semesters of it in about 90 minutes. Maybe the compressed time frame works. When we break for lunch, I don't typically go anywhere. So if you have questions or need a little bit of quality time, feel free to come up and we'll see if we can help with that. All right. So we're going to start with some basics, and we're going to take a fair amount of time to talk about terminology. GAAP. GAAP is generally accepted accounting principles. GAAP stands for generally accepted accounting principles. And what that is basically a set of accounting rules so that why are accounting rules important? Why accounting rules are important is so that we report consistently from one organization to another. If I don't do my accounting the way you do your accounting or you do your accounting, you start thinking about the ability to benchmark and say whether I'm doing better than you are or you're doing better than I am. If we're playing by 2 different sets of rules, nobody knows, right? It's hard to tell. So from a benchmarking perspective, it's important. If you have a relationship with a banker, the bankers are going to assume that the accounting is done a certain way. So really it's about consistency. So a lot of the things we're going to talk about, the concepts we're going to talk about are GAAP, generally accepted accounting principles, which is basically how accounting gets done and the rules out there for it. The second piece of terminology that I want to get in front of you is this concept of books and records. And when we talk about books and records, you basically will get a financial statement. And for those of you who may have looked ahead at the materials, you've got a balance sheet income statement as an Adobe file in there or as a PDF file. Those are financial statements. And that really is the oversimplified result of a whole process. So when we talk about the books and records, what we're talking about is all of the documentation that underlies or supports those financial statements. How did we get there? And what's our support? I want to talk a little bit about the entity concept. And the entity concept, it seems sort of like common sense, right? When you look at your financial statements, they should represent only the assets and obligations, the things you owe and the things that you have, and only the transactions, your revenues, your income, your expenses for one organization, right? So if you and I are both administrators for the same organization, right? And some of your expenses wind up on my facility's books, some of my expenses wind up on your facilities books, we've got a mess on our hands, right? Because you don't know what's yours and I don't know what's mine. So when we talk about the entity concept, we're basically saying all of our accounting information should only relate to our organization. That seems pretty simple, right? Seems like common sense. But you'd be surprised. We've seen situations where for an accounting group or for a group of nursing homes that have a single owner, one nursing home might be doing badly and one nursing home might be doing well. And one of the rules in accounting and business in general is you don't miss payroll, right? Employees have this thing about getting paid, and if they don't, they get scared. So what they were doing is they were taking the good performing facility and paying payroll for the bad performing facility out of the good facilities books. Well, that would have been fine, except they were recording bad performing facilities payroll on good performing facilities books. So now if you're a good performing facility, you've got more expense on your books than is yours, right? So trying to build a fence around that and isolate it, making sure that the books and records that you have, the financial statements that you have relate just to your organization. Consistency is important too. Remember I talked about GAAP, or generally accepted accounting principles, being this idea that the way I do accounting is the same way you do accounting, or the same way you do accounting, so that everything's sort of the same. Consistency is important too in your own books, in that you want to try and record transactions the same way month over month, right? So, for example, we have one of the biggest bills that we see for a lot of our skilled nursing facilities is the rehab bill, and they have contract rehab. It's a pretty expensive thing. And if you don't get that rehab bill reported in the month, the same way month after month, so what happens is the rehab bill comes in 5 days after month end, right? Maybe something like that. If I don't get that recorded in the month that it comes in, or pulled back into the previous month or something like that, you could wind up with 1 month that looks pretty bad because you've got that expense in there. And the next month looks pretty good because you don't have that expense. So basically recording your transactions consistently month after month. Again, part of accounting is trying not to make the accounting inconsistency mask something that's actually going on in your operations. So again, if you have a good month or a bad month, one of the questions that you probably want to ask yourself is, if I have a bad month, is it because my census is down? Is it because my electric bill was higher? Is it because, whatever? Is there some operational reason that I can think of why I had a bad month? And if there's not, is there something that's been done differently in accounting this month compared to last? So recording things consistently. I think the other thing we look at is full disclosure. And, full GAAP financial statements have these things called footnotes, where they talk about all of the line items on the financial statements and disclose and put more information around those. In my experience, most nursing homes don't have those footnotes on a month over month basis. You just get the financial statements, a balance sheet, and a P&L, or just a P&L or something like that. P&L meaning profit and loss or income statement. We'll get to that terminology too. The full disclosure, basically what we're talking about is making sure that, for consistency, we said the accounting information only includes, only the transactions of the nursing home or of the entity that you're looking at. For full disclosure, what we're saying is the books and records or the financial statements include all of the transactions of the nursing home. So there's not something omitted. So you've got only the nursing home consistently reported and making sure that we've got all of the transactions recorded in there. So something's not left out. Again, if none of these things, if any of these things get missed, you're not going going to be able to use the financial information as effectively as you might if things are consistent month over month, right? Is it something I did, or is it something I did as an administrator, or is it something you did as an accountant that's causing these variances? Talking about time periods, one of the things that's sort of important to know is what your fiscal year is. If you are a for-profit skilled nursing facility or a for-profit organization, generally your normal year end is going to be December 31st. So every year we do some more robust procedures in accounting to sort of tie everything down and make sure that it's, you know, take a last look and make sure things are done correctly, because that's typically when we do our tax reporting. If you are a Medicaid certified nursing home or ICFI ID, all of the nursing homes and ICFI IDs in Oklahoma report on a June 30 year end to Medicaid. So we'll have a fiscal year June 30 set of financial statements as well. So that can cause some problems. But knowing what your reporting cycle is. The other thing is knowing how you get your internal reports. Are you getting quarterly financial statements? Are you getting monthly financial statements? And kind of what's the time period? But we tend to measure accounting. We tend to measure financial statements in bites, and they're typically month-sized bites. So at the end of the month, reconcile the bank statement. We look at some reports. We do some analytical looking at the financial statements, and we say, all right, we're going to cut everything off for this month, and that is what it is. And we go forward to the next month. So we tend to look at things in month-sized slices. And finally, objective evidence. Transactions are supportable with documentation. When Medicare and Medicaid, the IRS, other regulatory agencies come in and audit cost reports or tax returns, they're looking for objective evidence. If you're an organization that has a financial audit done by a CPA firm, they're going to be looking for objective evidence. And what I mean by that is invoices, bills, remittance advices, and EOBs. Basically, to the extent that we can, third-party support for all of our transactions, right? And that makes sense. We shouldn't be recording our food bill off of anything other than an invoice from our food vendor, right? That kind of makes sense. So that's your terminology round one. All right, if you would, I think we can look at the accounting equation, and maybe the easiest place to see that is in you've got a document called balance sheet, I think. And if you want to look at that, I'm going to try and pull it up here on the screen. And I hope everybody can sort of see that. Okay. So when we talk about the accounting equation, there are basically three components to it. You hear about accountants being all excited when things balance. Have you ever heard that term used? This is the accounting equation. That's what we're talking about when we talk about balancing. So we have assets. Assets are the stuff that we have control over, kind of, right? So you think about what assets are. You've got cash in our bank accounts, right, or our petty cash or whatever you might have. You've got accounts receivable. Accounts receivable are things like, amounts due from Medicaid, amounts due from Medicare, amounts due from your residents or families for services that you have already, that you've provided. So, when you think about what that means, let's say that we have, let's say that we do billing for our residents that are Medicare beneficiaries on the 8th of each month, or the Tuesday following month end, or whatever your standard is. That is an account receivable until the point where we actually bring the cash in the door, and that jumps up to another line. So that's something, that accounts receivable is something that we've earned. We just haven't turned it into cash yet. Everybody with me? Okay. Inventory. We're seeing lots of folks now that have huge inventories of PPE, right? Lots of it. So inventory is something that we've got in our facility that we haven't used yet, but that we can use, or that we've stockpiled for later use. Other things you might see in inventory are your dietary food, medical supplies, those kinds of things. So typically, things that you sort of have to have on hand and sort of use over time. We've got a term down here called capital assets, and capital assets are your property and equipment. So if you own your building, your equipment, computers, medical equipment, ventilators, all of that stuff. So you sort of get a sense that of what assets are, right? It's the stuff that we think of as us owning. The second piece of this is our liabilities. So the liabilities are what we owe. So I'm going to skip to the second line there. We might have a line of, I had a panic attack just now that my financial statements didn't balance. I looked at the numbers out of the corner of my eye and it didn't work. Like, gosh, how embarrassing would that be? But they do, so it's all good. You'll be pleased to know that my heart is back, headed back down. A line of credit. So we owe the bank $80,000 for cash that we pulled down on a line of credit, right? So we owe the bank. Accounts payable. Those are situations where, we talked about the therapy bills or the rehab company contract service bills that comes in on the 5th of the month. Until we pay that bill, it's an amount that we owe. Okay, so a liability is an amount that we owe. Accrued liabilities might be things like, well, think about this. If your organization has a PTO policy or a vacation policy, there's a certain amount of that you earn over time, right? They owe that to you. That's a liability. At the end of the month, let's say you get paid on your pay periods run the 15th and the last day of the month, but you don't get paid until the 20th, 8th, and the 20th of the following month. The amount of salary that the organization owes you for that pay period in that 8-day window between the 1st and the 8th, that's a liability. That's a current liability and something that's owed to you. And finally, you've got equity. Equity is what's left of your assets after you pay what's owed. So I tell my children that our family, you guys have heard all of these fun acronyms. I tell my family that we're a sitcom, which is a single income, 3 children, oppressive mortgage. If you want to look at how the accounting equation works, think about this in terms of mortgage, your house. So if you use the mortgage analysis, that's the word. Assets, that's your house, right? You look at your balance sheet, the stuff you own. Liabilities is what you owe, right? What do we owe on our house? Mortgage, right? Note payable to the bank. When you take your house value and you subtract your mortgage from it, what are you left with? Your equity in the house. Right? So the accounting equation can be as simple as how you think about home ownership. Okay? I would have done a lot better in my first semester in accounting if my accounting professor had come up with that analogy. But no, it had to be conceptual. Questions on the accounting equation? It's kind of a big deal. So if you think about it in terms of your house and your mortgage and your equity, those things have to balance, right? The value of your house is equal to the value of your mortgage plus your equity, right? Those things have to equal. If I've got a $150,000 house and I owe $100,000 on my mortgage, what's my equity? $50,000, right? If I sell the house and pay off the mortgage, in a dramatically simplified world, if I sell the house for 150, I pay off my mortgage for 100, 50,000 comes back to me. That's the part of my stuff that I own. Boy, that sounds cynical, doesn't it? Equity is the part of your stuff that you own or that somebody else doesn't have a claim to. So think back about your balance sheet and sort of put that in context. All right. So if I start on the right hand of this slide, balance sheet is just what you looked at, okay? So when we talk about a balance sheet, this is a kind of important concept. A balance sheet is as of a point in time, today, or at December 31st of 2020. Today, this is all the stuff I have, this is the amount I owe, and whatever's left is what of my stuff I own, or my equity, right? So it's as of a point in time. If you're taking notes, write down balance sheet is a snapshot, or balance sheet is as of a point in time. Balance sheet is a snapshot. All right. We've talked about all of these concepts related to the balance sheet: assets, liabilities, equity and equity or net assets, right? We know what that is. I want to talk about current for a minute. The term current applies to assets and liabilities. And what it means is assets and liabilities that are available to us to use entirely within a year, or amounts that we are expected in the liabilities context, amounts that are due within a year. So if you were to flip back to your balance sheet, let's think about this. Cash, right? I could use that right now. Probably don't want to, but it's available for me to use, right? Accounts receivable. I don't expect that to take more than a year to turn into cash so I can use it, right? In fact, if it's more than 30 days, something has gone terribly wrong, right? Inventory. That's available for me to use right now. Contrast that. So when you see my caption there that says total current assets on my balance sheet, those are our current assets, assets that are available now or within the year. Now or within the year. On our current liabilities, accounts payable, your vendors aren't going to wait more than a year to get paid, right? Well, they might, but probably not. So those are amounts that we owe in the near term. Lines of credit always have a 1 year, kind of a 1 year max. So that has to be paid off or renegotiated annually. When I talk about current maturities of long-term debt, that's your mortgage payments in the next 12-month window. When I talk about accrued liabilities, those are vacation or PTO amounts or salaries that we expect to have to pay immediately. Okay, so it's all less than a year. Let's contrast that with our property and equipment. Yes, I know we use the building today and we expect to use it for a year, right? But we're not going to use it up. We expect it to be there for a longer period of time, right? We expect that to be there for a longer period of time. Now, let me ask you a question, just sort of an analytical question. How much current assets do I have? Ballpark, $230,000, right? So I have $230,000 of stuff that's available to me within the next year. How much current liabilities do I have? 500,000, right? How do my financial statements look? If I've got to pay $500,000 worth of liabilities with $230,000 worth of assets, what do you think about that? Is that good or bad? It makes you anxious. It makes me anxious too. Does that make sense? So I've got to find a way through, so I'm looking at this, when I think about a balance sheet, if I'm you, I'm looking at this and I'm going, oh my goodness, how am I going to come up with that other $300,000 200 and whatever it is, $285,000. How am I going to come up with that other $285,000? Where is that going to come from, right? So you're learning. All right, so that's current. We're going to talk about the income statement for a minute. Okay. Talking about our terminology, the first item on that list is net patient service revenue. That is the cash income or the amounts that we have earned from providing service to our residents. So your Medicaid money, your Medicare money, your vendor payments or co-insurance from your residents, your co-insurance, their family payments, if you've got a managed care contract, any of that stuff that we earn from those third-party payers or the residents themselves for room and board and nursing care and skilled nursing and all of those things. That's revenue. We might have other, or that's net patient service revenue. We might have other revenue as well. And other revenue might be things like interest income on your bank account at that whopping 0.2% that we're getting right now for those great big balances that we've got with all the COVID money that's sitting in our bank accounts, right? The government wants its share back, by the way. What else? Maybe we sell guest meals or sell meals to our employees. That might be another revenue amount. Maybe we have a charge for copies. I don't know if we do copies anymore, but used to be if you had, if you did copies, you'd charge a nickel a page or something like that. So any of those other revenue items, little dinky stuff like that, barbershop revenue, barber or beauty shop revenue, if you collect that and then pay the beautician or however you do it. So things that aren't really related to our main line of business, which is providing healthcare to residents, right? So revenue is basically, if you think about it from a cash perspective, and we're going to get away from thinking about things from a cash perspective, but cash is probably a useful place to start. Revenue's cash in, or what we earn make cash come in. Okay. The next thing we have is expenses. And you look at our expenses here, and you've got things like salaries and wages. Everybody understands that one, right? Employee benefits, and that might be health insurance or workers' comp. We usually see Medicare and Social Security taxes in there. Unemployment taxes are in there. Disability insurance, just depending on what your benefits package looks like. Those are the kinds of things that are in there. Purchase services, those are going to be things like contract nursing, registry nurses and aides. If you have a reference lab that you use, or a radiology company that does your radiology for you, your rehab, all of those kinds of things are purchased services. Quality of care fees, we know what those are, right? That's our provider taxes. Medical supplies and drugs, we understand that. We're going to get into depreciation later. Interest is what we pay on our mortgage, right? We know what interest is. And then there's other, which is things that don't fall into any of those other categories, right? So you sort of see what's there. So what you look at there, that's your expenses. Sorry, let me catch up here. The next thing we want to talk about is your net income or loss. So net income or loss is what have we got left over? This is what we're bringing in for our period. This is what we're spending. I've got $600 left, right? So net income is what's left after you earn your revenue and incur your expense. Net income is what's left. A bigger number is better. That seems obvious, but a bigger number is better. Everybody good on that? So that's your income statement. Those are your two basic financial statements. Now, here's the other thing that you want to understand about your income statement. Remember, I made you write down, Yeah, I'm delusional, like I have any power in this relationship. But I suggested that we write down that a balance sheet is as of a point in time. The income statement is for a period of time. So when you look at the top of your balance sheet, there's just a date, right? 12/31/2020. So that's the as of date on your balance sheet. That's the that's when the snapshot was taken. For your income statement, you notice it says year ended. And when you look at financial statements that are printed out of your systems, whether that's QuickBooks or Great Plains or Point and Click or whatever system you use, the income statement will have dates on it. And in fact, it might have more than one column. So what you might see is year to date, whatever that date is. So when you think about year to date, remember we talked about the accounting period? You want to know when your year to date starts. We're a January 1st period. Year to date, February 28th is 2 months. So it's important to pay attention to those dates. What I would say is when you look at an income statement, the natural thing is to look at the bottom line. When we say bottom line, we mean that net income line. Go ahead and indulge that because you won't be able to think about anything else until you've looked at it. But the second thing you want to look at on your income statement is what period it's for, right? So if I'm looking at a February income statement in the middle of April, there's a lot of water under the bridge. So thinking about that in terms of your periods. What you might have too is a year-to-date column, and you might have a month column. So you might have month ended February 28th, 2021, and year-to-date February 28th, 2021. So pay attention to those column headers so you know what period you're looking at. Okay. I think I covered that. Oh gosh, more terminology, right? It gets better, I promise. Shouldn't have promised that. General ledger. So if you are, a general ledger is basically the detail for all of the transactions or activity in an account, right? So, but it depends on the type of accounting system that you're using. If you're in QuickBooks, you can go into the general ledger and you can see invoice level detail generally, or bill level detail for every transaction that makes up the balance in your medical supplies account, for example. So the general ledger is just shows the activity for a certain period that makes up all of those balances we just talked about. I want to talk about closing for a minute, and this is a concept that I sort of referenced earlier. The process of closing, I had a client many years ago who thought that at any given point in time, you ought to be able to, click on today, and the financial records should accurately show what your assets are and what your earnings are month to date, 3 days into the month, right? The problem is it doesn't work like that. So we don't accumulate, for example, our Medicare charges necessarily on an ongoing basis, right? We accumulate those when we get the therapy bill at month end, or the radiology bill or lab or pharmacy bill or whatever that is, and we sort of put that all together at once. We also can't accumulate the expenses for those things because we don't necessarily know what they are, right? So the closing process is the process of basically saying, all right, it's February 28th. We need to make sure that all of our transactions got recorded in our financial statements. We're going to start by looking at a bank reconciliation, right? If you think about what a bank reconciliation is, you're basically just saying, if when I take what I've got, all the transactions I've got recorded, and I back out the ones that haven't gone through the bank yet, I should get the same balance as what's on the bank statement. That's a way to make sure all the transactions It might involve sort of looking at things analytically and saying, my gosh, my therapy bill hasn't come in yet. My contract rehab bill hasn't come in. So I need to wait until that comes in so I can close the books so that they're consistent from month to month. So the closing process is basically the process of doing a sort of a quality check on your accounting records to make sure all of your transactions are in and everything reconciles or ties back or agrees to what it should agree to. And then basically saying, books are closed for February 28th, I'm done. We don't record any more transactions back in February 28th. That financial statement is what it is at that point. We don't go back and cross over periods. So closing process is basically a quality control process. Typically it gets done monthly. Like I said, at year end, at December 31st and June 30th, we typically do a more robust closing process. They'll look into a little more detail because we have to report to the IRS, to Medicare, to Medicaid in those windows. So we want to make sure, there's a higher risk of those getting looked at by an outside third party. So that's your closing process. All right. Let's talk about the chart of accounts. If you look in the materials that I gave you, you should have something called, I don't know, what is it? Trial balance and chart of accounts or something like that. It looks like this. So you notice that on the financial statements and on your income statement, we have about, 10 lines, right? But we want more detail. So your chart of accounts, are you finding it? It should say trial balance at the top of it. We're good. Okay. So it's a little bit confusing, but I was trying to save a sheet of paper. That's what this boils down to in the good old days when we printed things. Your chart of accounts are the accounts that you can record your transactions to. So for example, we might decide that we want to look at our salaries for our RNs. So we might have an account for RN salary and one for CNAs and one for medical records and one for cooks and dietary aides and one for housekeeping or whatever. We might have separate accounts for that so that if we look at our financial statements, right, you've got one number, salaries and wages. But if I want to look at what happened, my salaries and wages went up, I may want to look at that chart of accounts or my trial balance and dig a little bit deeper. So what I would say as you look at your financial statements, think about this. They have to accommodate a couple of things. One of them is Medicare and Medicaid cost reporting. We have to have enough detail there that we can get our expenses and revenues on the right lines. Tax reporting, we have to have enough information there again that we can get our expenses and revenues on the right line. So those are important. You may have, if you have a line of credit or a mortgage, you may have a situation where you want to make sure that the bankers have the information that they need from the chart of accounts. But what you want is important too, right? So make sure that you have enough information in your chart of accounts that you can look at account level detail and see what the trends or what the what the direction of your what the direction of your revenues and expenses is. So to give you an example, we see a lot of charts of accounts for nursing facilities where there's one salary. One salary. Look at your income statement for a minute if anybody's got that handy. What's the biggest number in the expense part of your income statement? Salaries. It's really big, right? Like nothing else is even close. That's what we have to manage, right? That's the expense we have to manage every day through scheduling, through call-offs. There's an HR component to that and employee satisfaction. That's something we have to manage the daylights out of, right? Yes.
When you say chart of accounts, does that mean like all these combined?
Yeah. So your chart of accounts is these two columns,
Okay.
the first two, yeah.
Just,
The
when you
chart
say
is-
chart of accounts, you just mean these two.
Yeah, basically those two pieces of information. So basically every transaction, I'm sorry, thank you for that question. Every transaction that goes through your organization has to fit in these buckets. Right. So when you look at salaries again, you want to make sure that you've got enough detail that you can get things in the right bucket and have it be meaningful to you. Think about things like that. We see some accounts where, a chart of accounts where there's one account for insurance. How many kinds of insurance are there? What can you think of?
The employee insurance?
Health insurance, yeah. Workers' comp insurance. What else is there? Vehicle insurance, auto insurance. What else? Facility,
Vision, dental, I mean, there's.
Vision, dental.
All broke down on
liability, professional liability, maybe directors and officers. That's like 7 kinds of insurance, right? Or 10 or something like that. If they're all in one account, can you manage all of your insurance like it's the same type of expense? Let me ask you this question. What drives the cost of employee insurance? Number of employees you have, right? Yeah, what did you say? Sorry.
Sickness, like.
Sickness, right. So what's your experience, right? Yeah. Employee insurance,
Ours,
do you have a safety program that's dealing with your workers' comp? All of it, yeah, exactly. All right, so employee factors, number of employees is a good one too. What drives liability insurance or professional liability insurance? Your claims experience, right? Did we get sued? And Oklahoma's claims experience, right? What drives your auto insurance? As the father of teenage daughters, I have some thoughts on that matter. What drives your auto insurance cost?
Accidents.
Accidents, age of drivers, right? How can you manage a pool of expenses together where you've got so many different drivers, right? But the cautionary tale here is don't go overboard the other direction where you've got, detail. So for example, same client that had salaries as a single account, they had a separate item on their chart of accounts for fabric software. Because we want to track that ever elusive and subject to misstatement fabric software cost, right? You can go over batteries, coffee, vent hood cleaning. I mean, I've seen accounts that have all of this kind of stuff in it. Don't distract yourself with that stuff. Get it? That's all, fabric software, that ought to go with your housekeeping or laundry department, right? Just a general expense there, right? So think when you go back, just out of morbid curiosity, when you go back, ask to look at the trial balance or the chart of accounts and see what level of details in there. There's a 50 to 60% chance you're going to have a good laugh. Does that make sense? All right. So I said that the general ledger is where we record all of our transactions, but we also have other types of journals that are available with us, that are available for us to use to record transactions, like the cash receipts journal. That's where we record our cash in. In automated systems right now, that's going to be where you, again, if you're QuickBooks or PCC, that's where you post your cash receipts. And you think about what typically is involved there. You have to know what resident the cash receipt is for, right? You have to know what month or period of time the cash receipt was for. You have to know the amount of the cash that got received. So as you post those things, there's a lot of information tied up in there. And by the way, if you don't post your cash receipts correctly, what happens if I post a cash receipt for January against a bill for February? I look like I've got a 60-day past due account, right? The family is not happy. So getting that done right. We'll talk more about accounts receivable down the road, but that's a piece of it. Your billing journal is where you record the bills that go out. Sometimes we use billing logs. But basically, when you do your bills for Medicaid, when you do your bills for Medicare, you do what we call capturing charges. So we say we had this many days, this was our PDPM category, this is the payment rate associated with that. In this month, we had this much radiology charges, this much lab, this much PT, OT, ST, this much drugs or medication expenses or medication charges. Those are all things that go in our billing journal. That PDPM rate, we back away our coinsurance from that, and that's what we expect to get paid by Medicare, right? So when we're posting in the cash receipts journal, it really helps if the billing journal is right. Because that way when you post, you can sort of tell what charges have been cleared or what payments have been received and making sure that they're accurate. So that's what we call your revenue cycle, cash in. You've got accounts payable. So in a certain system, in a certain type of system, when we have a vendor invoice come in and it gets approved, and we'll talk through that whole process, it'll be very exciting, I promise you. When we have an invoice come in, we report it in our accounts payable so we know what we owe, right? So when we have it, it's approved, we're agreeing that we owe it, we're going to go ahead and put it in our system. And then when we do a check run, which is recorded in a check disbursement journal, or cash disbursement journal means check register, right? We know how much to cut the check for. We have a payroll register. And the payroll register is complicated as all get out because it's got your hours, your pay rates, your employees' deductions, employer expenses, your taxes, all of those sorts of things are all tied up in there. So managing that payroll register, that's a place where you're probably going to spend some time as well. And finally, you've got a general journal, and that's for any transaction that doesn't fall into one of these other categories. We record those in a general journal with what's called a journal entry. For an accountant, journal entries are non-automated processes that are relatively high risk. So, you want to look at the types of transactions. When I go in and do an accounting review for a client, I look at it and say, what types of transactions are we making manual entries for, as opposed to flowing through one of these other journals? That's a risk indicator. So that's all the stuff. When we talk about the books and records, that's all the stuff that makes up the books. All right. This is going to be tough, so stick with me, okay? There are two basic types of accounting that we do, accrual basis and cash basis. For cash basis, we record, and what they have to do with is the period when a transaction gets recorded. Remember I said that accountants view life in 1 month slices, right? So which month do we record the transaction in? So for cash basis, we record transactions in the period when the cash changes hands. In the cash basis, we record a transaction when the cash changes hands. So to give you an example, let's stick with Medicare because it's the easiest one. It's the easiest to understand. Most of us bill Medicaid on a weekly basis. Most of us get paid for private pay on the front end of the month. So those are a little bit harder to follow. But for Medicare, what happens? We typically bill in monthly increments, right? So right about now, I suspect the billers back at your buildings are trying to get the Medicare bills out the door. For what? For when? For February, right? So February's cash, the Medicare revenue that we earned for the service that we provided in February, when does that cash come in the door? March, right? Because we bill by the 10th or 8th or whatever it is, and it takes 10 to 14 business days to come in just in time to cover that last payroll of the month, right? That's how that works. So it comes in March. On the cash basis, we would record that revenue. It would wind up in our income statement in March. Contrast that with the accrual basis. Transactions are recorded when they're earned, right? When did we provide the service for the billing that comes in March for Medicare? February, right? So I'm saying we provided the service in February. We earned the revenue in February. So under the accrual basis of accounting, we would record the revenue that we earned in February. Under the cash basis of accounting, we would record the revenue that we earned in February when the cash comes in, which is March. So cash basis means when did the cash change hands? Accrual basis means when did we earn it? Let's turn that on its head. Let's say that we have a monthly, well, we've been talking about the rehab bill all along, right? So let's just continue on that. For the services that our, Rehab Care or Rehab Works or whoever, that our therapy company, contract therapy company provided to us in February, when do we get the bill? March, right? The bill comes in second, third day of March, last day of February, maybe. As a result, when do we pay that bill? March, yes, okay. So on the cash basis, when does that expense get recorded? March. Everybody with me? Cash changes hands in March. That's when we record it under the cash basis. But when do we owe? When do we, I'm going to use the term incurred. When we incurred an expense means that the vendor or the employee has done what they need to do for us to owe them the amount. When did we incur, or when was the service provided, or when were the goods delivered? In February. So when do you think we record that expense under the accrual basis? Yes, you got it. I made it too hard. Good job. Everybody with me on that? All right, so there's a conspiracy theory out there that accrual basis was something that was created by accountants to make sure that our revenue stays strong, because it's a little bit complicated to deal with. And I'd be hard pressed to argue with that logic. But it is superior in a lot of ways. So let's think about this for a minute. When do you get financial statements? All right, so let's stick with February versus March for a minute, right? If we have, so we have February is behind us. We go through our closing procedures. Remember, we reconcile all the junk and make sure things tie out and give the food vendor an opportunity to get the last food invoice in, and we might be waiting for a rehab bill or whatever, but at some point we close the books. We say this is it. And we might do that by the 12th of the month or the 15th of the month. When do we get our financial statements for February?
After that.
After, yeah, so end of the following month, right? All right. So if we're on the accrual basis, what transactions are in the financial statements we get in March? What month's activity is in the financial statements that we get in March? February, right? So I provided service in February. I know what the result of that is by the end of March, right? That's accrual basis. That was the easy question. Are you ready for the hard one? I don't think anybody's tuned out at home, so that's a good sign, right? This is somebody's wishing for a potty break about right now. I have a feeling. Here's the hard question. If we're on the cash basis, what month's activity are we seeing in the financial statements that we get in March? We're seeing cash in from February. I'll stipulate to that. But what month's activity do those cash receipts in February relate to? January, right? Everybody see that? So on the cash basis, I provide the service to my resident in January. The cash comes in February. The financial statements come in March. So there's a built-in month lag in cash basis financial statements. Which would you rather have if you're responsible for financial performance in your facility? Yeah. Would you like more timely information? No, I prefer less timely information if I can get that, right? Nobody says that. Accrual basis makes the information more relevant because A, you're matching revenues and expenses, right? And B, you get the financial statements a month sooner. Or you see the results of your activities a month sooner. Everybody with me on that one? All right. We did that. All right, so here's another question for you. How many of you have ever heard we had a bad month this month because it was a 3 payroll month? Anybody? All right. That means you're on a biweekly pay period, right? Meaning that you pay your pay periods run every 14 days. That's how biweekly works in my head, okay? So let me ask you a question. How many of you have ever heard we had a good month this month because it was a 2 pay period month? Nobody ever, right? The 3 pay period month is a hoax. Here's why. How many days are there in a biweekly pay period? How many calendar days are there in a biweekly pay period? 14. If we have a 2 payroll month, how many biweekly pay periods are there? I mean, how many days are there in 2 biweekly pay periods? 28. That works. We're going to abandon February as an example because February is a 28-day month. But let's move on to March, shall we? How many days are there in March? So if we have cash basis financial statements, right? And March is a 2 payroll month. How many calendar days worth of payroll do we have in March? 2 biweekly pay periods is how many days? 28. How many days are there in March? 31. So we've got 28 days of expense on the cash basis in March. You've got 31 days of patient service in March, right? Unless you guys are one of those nursing homes that evicts everybody on weekends. Sends them home or whatever. I'm sorry, we got to our 28 days. Everybody else. That's not how it works, right? We're there. So the 2 payroll month has 28 days of expense in a 31-day period. Everybody kind of follow that? What happens in a 3 payroll month? Okay, this is where higher math comes in. How many days are there in 3 biweekly pay periods? 3 times 14 is 42. How many days are there in March? 31. So in a 3 payroll month, you've got 42 days worth of expense in a 31-day period. Everybody see that? That's another indicator of how cash basis can distort your financial statement. So if you're asking yourself the question, am I looking at cash basis financial statements or accrual basis financial statements? The first question you might want to ask yourself, have I ever heard the 3 payrolls? If you have, you're probably looking at cash basis financial statements. Although the other issue with the 3 payroll period month is that our revenue typically comes in 1 time a month. And we sort of think about that in terms of, we get that Medicare payment on the 25th, 26th of the month. A lot of us rely on that to make payroll. If it's a 3 payroll month, we've got some cash issues to deal with. Just because of the time. Everybody follow that logic? Okay. I think we've talked about this. almost all of this. I will say that accrual basis accounting is used for Medicare and Medicaid reporting. That is a requirement of those programs. So even if you maintain your books on the cash basis, at year end, you've got to convert them to accrual basis. Cash basis is often used for tax reporting, but again, your tax accountants are used to converting accrual basis records to cash basis. So, it's easy to manipulate cash basis financial statements. If we have a good month, we have to ask ourselves if we're on the cash basis, did we just defer paying something to the next month? Have we robbed March to make February look good, right? All right. Oh, the hits just keep on coming. Double entry accounting. Here we go. Remember I said the accounting equation, assets equal liabilities plus equity. Everybody remember that part? The only way that works is if we have double entry accounting, meaning that every transaction we record, it's two accounts at least, right? And you have to have your debits equal your credits. All right. So we're going to talk about memorization for a minute because I have no idea. After I was telling Z, I think this is my 35th time to teach this course. Some of this stuff, there's just no way to get to the concepts on it. In 35 times teaching this, I still don't understand how I'm supposed to explain the concept of debits and credits. So we're going to rely on memory. Okay, and it works like this. We refer to debits and credits as an account type having a normal balance. What a normal balance means is when you increase the account, is that a debit or is it a credit? All right, so for assets, when we increase them, it's a debit. For expenses, when we increase them, it's a debit. For revenues, when we increase them, it's a credit. For liabilities, when we increase them, it's a credit. Okay, just take my word for it. A friend who grew up an engineer, and she thinks that accounting is just about the stupidest thing she's ever seen in her life. She thinks, she told me at one point that accounting is not a profession, it's a disease. And I'm hard pressed to argue with her based on the number of accountants that I know. Here's her logic. Are you ready for this? And I'm going to solve the world's debit credit problem for you. In case you panic and forget, assets and expenses have a normal debit balance. Liabilities and revenues have a normal credit balance. When you increase an asset or an expense, it's a debit. When you increase a liability and a revenue, it's a credit. In case you forget. The reason she thought that accounting was so stupid is that when she gets her bank statement, her debits are decreases in her bank, or decreases in her cash, right? When you see debits, that's a decrease in cash. Is cash an asset? Didn't I just say that an increase in cash is a debit, not a decrease? That doesn't make any sense, does it? Why would the bank look at it one way and and the accountants look at it a different way? Exactly the opposite. Think about that. The thing I should have told you that I didn't is that when you increase an asset, it's a debit. When you decrease an asset, it's a credit. When you increase an expense, it's a debit. On the rare occasion that you decrease an expense, it's a credit. When you increase a revenue, it's a credit. When you decrease a revenue, it's a debit. When you increase a liability, it's a credit. When you decrease a liability, it's a debit. But back to banking. If in accounting, I increase an asset and it's a debit, why is it that from my bank statement, when I increase an asset or increase my bank account, it's a credit, right? Why is that, do you think? is their perspective. That's right. Because your bank account at a bank isn't their asset, it's their liability. So the whole thing is from the bank's perspective. So here's your party trick for debits and credits. Are you ready for this? If you think about a transaction, think about how it would look on your bank statement and do the opposite. So every transaction has to balance. If you think about a transaction from the perspective of cash, think about how it would show up on your bank statement and do the opposite. So if I have cash come in, bank says that's a credit, the accountants say that's a. If I have cash go out, the bank says that's a debit, the accountants say that's a. That's your party trick. It's a good one. Trust me. All right. So debits and credits. So I want to think about maybe some illustrative transactions, and this is not in your materials. And for those of you following along at home, this is going to be a little bit hard to follow. I probably should have sent these transactions along, but I wasn't that smart. But I'm going to try and blow it up so you can see it. All right. Let's start here with utilities expense. I want to walk you through ignore the man on the screen for just a minute. I want to walk you through a thought process. We're going to walk a transaction through accrual basis accounting. We get a gas bill in, right? We agree, we're going to pay it. We enter it in our accounts payable system. We're increasing expense. And since we're increasing an expense, is that a debit or a credit? You can look at your notes. We're increasing an expense. If an expense goes up, is that a debit or a credit? It's a debit. That's right. Now we have durable entry accounting, so we know we need a credit too, right? What are we increasing? At that point, we're saying we owe somebody for that gas bill, right? That's a liability. If you increase a liability, is that a debit or a credit? Credit, that's right. Good job. All right. So that's not good enough, right? Then we have to pay the gas bill. Okay. So when we pay the gas bill, the cash goes out. The banker says that's a debit. So we say it's a, right? So we've got our credit. We need a debit on that transaction too. What do you think our debit is?
Utilities.
Our credit is the liability. I'm sorry, our credit is the assets because we're decreasing our asset, our cash account. This is hard. But we don't owe that anymore, right? Once we've paid it, we don't owe it. So our liability gets debited for that same amount. So in the end, we've had a transaction go in and out of a liability account, right? In and out of a liability account. We've got a debit for $2,000 on the books for utilities expense. And we've got $2,000 less cash than we started with, right? And we show no liability because we put it in, increased our liability, and we took it out. Everybody with me on that? Kinda? All right. Let's try another one. Let's say we have one Medicare patient and our bill for them is $3,000 at the end of the month. We know we have revenue, right? We've earned revenue at that point. Does revenue have a normal debit or credit balance? You can look at your notes, it's okay. Revenue has a normal credit balance, so we're going to credit revenue. We know we need a debit for that same amount, right? What's our debit go to? Accounts receivable, because somebody owes us, right? Cash comes in the door, we hope. Our cash goes up. The bank says that's a credit, so we know it's a debit. And so we know we need a credit. What's our credit go to? Accounts receivable. You're right. I like the way you're thinking. Cash basis, you'd be right. Accrual basis, though, we have to take out that accounts receivable, right? Because we're not owed that amount anymore. So if you think about what's happening here, we said we wanted revenue on the books and we wanted cash on the books when the transaction's over. Accounts receivable is a wash, 3,000 and 3,000. So when we record things on the accrual basis, this is sort of the lesson about debits and credits kind of coming full circle. When we think about debits and credits, and you think about the accrual basis, the way you put things on the books when you don't have the cash yet, is you record them in liability accounts and asset accounts. And then once you convert those to cash, you take them out of the liability accounts or the asset accounts, depending on what it is. But what I'm going to suggest to you is that you think about when we have a transaction. Once again, think about it this way. This is the logic here is a little, maybe this helps, I don't know. It helps some people, it may not. It may not help everyone. We know when we have revenue, that's going to cause ultimately cash to increase, right? We know when we have revenue, that's going to cause cash to increase. So the cash impact is, according to the bank, credit, so we know it's a debit, right? So we start with the cash piece. Debits and credits have to equal each other in a transaction, right? We know the cash in piece is a debit. We know the other side of that is revenue, right? Ultimately, so we know that our revenue has to be a credit because debits and credits have to equal. So if you can figure out what the cash is, how that would look on your bank statement, and flip it on its head, and then think in terms of debits have to equal credits, you can get there. But it's probably easier just to memorize those normal balances, right? I may have mentioned this before. Assets and expenses, when you increase them, it's a debit. Liabilities and revenues, when you increase them, it's a credit. Commit it to memory, write it on your hand. I don't care what you've got to do, keep that one in mind. There's no rhyme or reason, it's just vocabulary. Okay. That was the first semester of accounting, leaving me about 10 minutes for the second semester. And we're going to make it. Assuming I get the PowerPoint done. Ready? All right, we're going to talk a little bit about understanding financial information. And this is an area where, again, I don't think no one in your position is going to analyze financial information using all of these ratios we're going to talk about. So again, about the best thing you can do is memorize the equations. I hate to say it, but some of this will figure on the exam. It will have no relevance in your professional life. Learn it long enough to get through the exam and then forget it. Use that space in your brain for something else. But let's start here. Let's look at working capital. Remember early on, we talked about how I have $230-some thousand of current assets and $500 and some thousand of current liabilities, meaning that I'm host. I mean, that's basically what that means. I've got a $285,000 shortfall. This ratio measures that. So if you take your current assets, and if you want to look at your balance sheet, you can see where these numbers come from. They're actually tied together. But your current assets minus your current liabilities is your working capital. A higher number is better So I've got current assets of 233,000. I've got current liabilities of 500,000, which gives me working capital. I'm making words up. Working capital of $282,000, right? What that means is I'm short by $281,000. If those numbers were flipped, where I had current assets of 515 and I had current liabilities of 233, I'd be ahead, or I'd be ahead. This is called, this is basically a measure of liquidity. Liquidity, when we use that term, what we're talking about is the ability to pay bills as they come due. All right, so the working capital is one way to look at this. The other way to look at this same problem is what we call the current ratio. And what we're solving for with the current ratio is we're saying for every dollar of current liability that I have, how many dollars of current assets do I have to satisfy? For every dollar of current liability that I have, how many dollars of assets do I have to satisfy? And the answer is not enough. So what you do is you take your current assets, $233,000, and divide that by your current liabilities of $515,000. And the current ratio says, I've got 45 cents of assets to pay every dollar of current liability. Below one is bad. Everybody kind of see that? If I've got bills outstanding of $1 and I've got 45 cents in my pocket, that is not a good scenario. That's what the current ratio is all about. Does that make sense? Agree with me? Sorry, I'm putting a burden on you five because I can't see what everybody else is doing. So the nodding and all of that, as long as you're not, the eyes closing sends me a message too. So I appreciate that. A quick ratio is basically recognizing that some of our current assets we can't spend. So to say this one way, if you get a bill from Oklahoma Gas and Electric, you can't pay them in PPE, right? Although you might be able to now. I don't know. I mean, it's like cigarettes in prison. I have a feeling at this point. But you can't pay them with PPE, which would be an inventory, right? So what we've said is, for a quick ratio, we're going to take out all of that stuff that we can't spend and just focus on the things that we can. So it's the same math. It's just that instead of current assets, we use cash, accounts receivable, and investment securities. And in that case, the news is not any better. You've now got 40 cents in your pocket. It's like having 40 cents in your pocket and a nickel's worth of lint is the current ratio. The quick ratio is just the 40 cents. Think about how much lint is a nickel's worth. So it's the same idea, just different numbers. All right, average collection period. The way they do the math on this in the book is bass backwards. It doesn't make any sense. But if you want to memorize it, that's how you do it. You basically divide your accounts receivable by your average revenue per, that should not say patient day, that should say per calendar day. Apologies there, average revenue per calendar day is your average collection period. So what we do is we say, here's how much revenue I have, 2,778,900. And I'm going to divide that by 365 days in a year. And that gives me a daily revenue amount of $7,613. $7,613. So basically what that says is every calendar day, on average, I'm earning $7,613 of revenue. Medicare, Medicaid, private pay, revenue. My accounts receivable is $134,200, right? If I divide that 134 by my daily revenue per calendar day, I get 17.63 days. 17.63 days. Is that good or bad? Well, if you want to answer it depends, I would have to agree with you. Okay? What we're basically saying is, on average, I've got 17 days worth of revenue, 17 calendar days worth of revenue that I have not collected, that I've earned but have not collected. Okay, so let's think about that. If I am a private, let's make some wild assumptions because that's more fun. What if we make the wild assumption that my facility is 100% private? When do private pay residents typically pay? In advance or at the end of the month? In advance. How much should your accounts receivable, the amount that private residents owe you, be at any given point in time? 0, because they pay you before you earn it, right? So if you're a pure private pay facility and you've got 17 days worth of revenue sitting in your accounts receivable, that's a bad number, right? Everybody kind of see that? That's a bad number because that should be 0 or very close to it, right? All right, let's go the other easy example. If you're only a Medicare facility, when do you bill Medicare? Beginning of the month following the month your service is provided, right? All right, so let's think about that for a minute. If it's February the 28th, and I bill Medicare on the 5th of the month, and I have a 10 business day window before I expect to get paid, that's 5 and 10 plus weekends, call it 19, 20 days, something like that. We get paid on or about the 20th, 25th, somewhere in there, right? That's 25 days worth of Medicare revenue sitting in my accounts receivable at February 28th, right? If my number is 17, is that good or bad? It's really good, right? Because I basically got less revenue sitting in my AR than my expectation, which is that it's going to take 25 days to collect. Everybody kind of with me on that? Okay. And then there's Oklahoma and our billing Medicaid on a weekly basis. And I don't know what the answer is on that, right? Because we bill every 7 days and it takes 10 days. And it seems to me like 17 days ought to be about right for Medicaid. But you see how it would depend on what your payer mix is, right? If we're mostly private pay, that's a terrible number. If we're mostly Medicare, that's a pretty good number. And if we're sort of an equal blend of those things, it's probably about where it needs to be. Thumbnail idea is if that number is more than 30, there's a problem. You're not getting things collected. All right. I just talked about that. Average payment period is the same math as we did on our days revenue and accounts receivable, but applied to accounts payable. So what we do is we say, what expenses do we have that are paid to vendors? So we don't pay employees through AP. Depreciation and interest we typically don't pay through AP. So it's just our vendor payments. So we've got our vendor expenses, which are basically our total expenses less our salaries and benefits. $1,262,000. Our days in our period are 365. So our average daily non-salary expense is $3,458, right? In general, we generate $3,458 of expense every calendar day. That's due to vendors. Our accounts payable is $256,000. If you divide $256,000 by our daily vendor expense, you get, what did I say, 74 days. Let me ask you this question. Are our vendors happy campers at 74 days to pay? They are not. They are not happy campers. Again, if that number is much north of 30, you're probably having cash flow issues. Pretty good? Okay. Net operating margin. So now we're looking at the income statement. So if you want to flip over and look at that one, net operating margin is basically a measure of how much of the revenue that we bring in are we getting to keep. Okay, so what you do is you take your net income, $593 in that income statement, divided by your total revenue, and basically for every dollar that we bring in, we get to keep 2 cents. For every dollar that we bring in, we're keeping not 2 cents, 0.02 cents, which is not good, but at least we're keeping something, right? So again, your operating income divided by your operating revenue gives you a percentage, and what that percentage is telling you is how much of what you bring in you're getting to keep. Debt to equity ratio is another one that we very rarely see. Bankers use this one all the time, so if you're doing financing, they might look at it. And what you basically do is divide your long-term debt, typically your facility mortgage is going to be the main one, but you may have some others, by your members' equity. And what we're basically saying here is that our debt is 13 times our equity. The ones that we use typically are the average daily census, which is patient days divided by days in the period. Patient days, everybody knows that that's basically heads in beds at midnight. On one day is a patient, one head in one bed at midnight is one patient day. You aggregate that from the facility. Most of us are keeping track of that by payer, so Medicare, Medicaid, private pay, whoever the primary payer is, we're tracking that because it tells us something about rates and other things of that nature. Occupancy is our average daily census divided by our licensed beds. So if we have an average daily census of 70 and we have 100 licensed beds, our occupancy percentage is 70%, 70 divided by 100. Our average length of stay is our patient days divided by our admissions. This has very little meaning for private pay and Medicaid residents that tend to be longer stay. But from a Medicare perspective, this is a number that we look at and we benchmark. Oklahoma, the last benchmark I saw, that was running about 30 to 32 days on average for a skilled nursing stay in a freestanding skilled nursing facility. And finally, you hear talk about full-time equivalents. What full-time equivalents are is the number of hours worked times 8 hours, divided by 8 hours of work. So for example, in a year, if we have an employee that works 2,080 hours, which is 52 weeks times 40 hours a week, right? If they work 2,080 hours, that's one full-time equivalent or one FTE. That's how the math is done. The nice thing about full-time equivalents is when you start thinking about benchmarking, your workforce may be almost entirely full-time employees. Your workforce might be half full-time and 2/3. Half full-time and then 2/3 of the employees are part-time. But if you want to look at staffing ratios, you sort of convert that to a common ratio. So 2 employees that each work 1,040 hours versus 1 employee that works 2,080, that's both 1 FTE, even though you've got 2 bodies for it. We look at things on a cost per patient day like crazy. The cost reports, Medicaid reports, have got a great deal of information on this. If you're looking at budgeting or some of that sort of thing, looking at costs per patient day is a way to go about that. Staff hours per patient day, that's something else. In Oklahoma, the average is somewhere around 3.6 RNs, LPNs, and aides, including your DON and MDS coordinator per patient day. If your building is staffing much above that, you've got to ask yourself whether your patients are sicker than everybody else's or whether you're overstaffing. If your building is staffing much below that, you've got to ask yourself if you're putting yourself at risk for poor patient care. So looking at your direct care hours per patient day is kind of a big deal and really something that I spend a fair amount of time on. It shows up in Care Compare, or what used to be Nursing Home Compare. That stuff is all calculated on an hours per patient day basis to look at too. All right, I went over budget by 5 minutes. Why don't we let's take an hour for lunch, shall we? And reconvene at 10 to 1. Does that seem fair? I'll be around if you have questions.
This conference will now be recorded.
How are we? Yeah, way to sell it. All right. So we're going to leave the accounting for just a minute in terms of the numbers and process and financial statements a little bit. We're going to talk a little bit more about accounting processes and why we do some of the crazy things that we do. Just so you sort of have an understanding of how accounting processes work and to give you more of a flavor for some of the control processes that are involved. So I'm going to start with, apologies. Here we go. Let's start with billing and collecting. I think that monitoring, one of the things that I've seen be most problematic in an awful lot of nursing facilities is the billing and collecting process, and how do we monitor that? And if it's not done well, you basically wind up providing service and not getting paid for it. And that's not where we want to be. The margins that we see for an awful lot of the facilities that are out there are razor thin to begin with. And if you don't convert those services into cash in the door, it's really problematic. First of all, you can't spend accounts receivable, right? You've got to convert it to cash before it actually is usable. That's sort of an obvious point. But the other issues I think that surround it are the kind of the reputational issues, right? Because if we don't bill well, we delay cash receipts, which delays our ability to pay our vendors at best, and at worst, it delays our ability to pay our employees, which is really problematic. So getting that cash flow is an issue. If you don't bill well, you can cause the facility to not get paid at all. And we've seen some of those. I mean, you guys may have seen this a little bit in the places where you work, where, the timely filing deadlines are shorter now, and we think they're going to continue to get shorter. So basically, what that means is, for certain payers, if you don't file within a certain time period, if you don't file a claim or send a bill within a certain time period from the date that the service is provided, they basically say you didn't bill us timely, so we're not going to pay you. And that's bad. And some of them will say if you don't send a compliant bill in that or a clean claim in that window, they can land you in jail. EKD provides skilled nursing billing services. My company provides skilled nursing billing services to something like 100 nursing homes nationwide, including Hawaii, by the way. I'm not going to go to that one, but one of the things that our billing group leader is fond of saying from a compliance perspective is you can have all of your nursing documentation just right. Physicians can have signed off on the plan of on the care plan. Everything can be absolutely in order. And when your biller sits down to send a bill in, they don't have something in the system right, and they might check a box that caused the last claim to go through. And at that point, that box that they check to make that claim go through doesn't represent the truth. You've done everything right. And in the interest of getting a bill submitted timely, you've committed fraud. And that's not good. Billing is one of the highest risk activities that we do. So it's important from a compliance perspective. It's important from a cash flow perspective, I mean, it's just really the revenue cycles are really kind of a big deal. And I think it can destroy your reputation in your community, as well, if you get a reputation for sending bills when amounts aren't owed, and that can happen with, problems with posting, that can happen with problems, not computing rates or updating your rates in your system, or not updating for employee coinsurance, or not employee resident coinsurance. A number of things can cause those problems. And you sort of get that reputation as, not being the nursing home in your community where people want to go because of the billing issues that surround that. All of these things we've seen happen over time. And you don't want any competitive disadvantage for your facility. And really, we have enough trouble reputationally without dealing with billing. So I'll get off my soapbox, maybe. So when you look at this as an administrator, what do you really want to see? And what do you want to see in your processes? And I think, the idea is, how do we make sure that we get paid? Maybe we're sitting down with your business office manager or your biller and talking about, how do we accumulate the information to get paid? What's our process for billing? What's our timeline? Who are our problem children? Who are the residents that we're having trouble collecting from? Do we have some residents where, the Oklahoma State Department of Health local office is behind on determining Medicaid eligibility, so we're providing service for free for 3 months, 6 months, whatever it is, until they get that all worked out. And so when you start thinking about how do you make sure that you get paid, I think you've got to start with documenting your residents' payment source. Who is going to be paying for the care that you provided? This is a routine thing. It happens when you and I go to the physician, right? The first thing they ask for is, who's going to be paying the bill? Give me a copy of your insurance card if you've got one, whatever that is. We need to be documenting that. But I will tell you that one of the things that we're seeing quite a little bit is that managed care continues to evolve on the Medicare side. So people that don't have traditional Medicare, they have Medicare managed care products. And so what will happen is a resident may have a Medicare card and they may still be carrying it around, but they may be in a managed care product instead, and that card may not be any good. So when you admit a resident, the very first thing you're going to do once you've got the file in is verify that payer source. So not just make a copy of the card, but verify the payer source. Some of our systems have the ability to do that. There's a form within the billing systems that can be sent out to a payer source to verify that, but probably worthwhile understanding how we verify that payer source. And by verify, I mean check it online, get on a phone, talk to somebody and verify that this resident does indeed have this benefit. If it's a skilled patient, you want to probably verify the primary payer, and if there's a secondary payer, you probably want to verify the secondary payer as well. If they've got a secondary insurance or a Medicare supplemental policy. So the other thing is, we've talked a lot as we've talked about accounts receivable and some of those metrics about, what those processes are. I've said basically, we finish out a month and our standard is we try to bill Medicare by the 8th of the month or the first Tuesday following. We try to bill Medicaid weekly. How does that work? It's you try to get it in by Wednesday at 5 so you can get paid the following Thursday, because that's how the claims process for Medicaid based on when you get the dollars in the door. But get in a rut and understand what those processes are. It's sort of like, if you ever dealt with payroll, you know that nobody bothers whoever's processing the payroll on payday, right? Or on the day they process it. From the biller's perspective, nobody bothers the business office manager on the day the bills are supposed to be going, right? That's job one. So, and understanding what those processes are is kind of a big deal too. How do you deal with things that are the resident's responsibility? Invoicing before month end. How do you capture special charges, whether that's meals or beauty shop or whatever that is, that gets sort of tacked onto the resident's bill if you charge separately for those kinds of things? So understanding what that process is for getting the bills out is step one. And basically, if we know the bills go out on the 8th every month, we're coming in on the 9th and saying, did the bills go out, right? And how much did we bill? How much cash do we have? Those are the things that we want to know. The second thing is the follow-up process. So now the bill's out there, and the vast majority of our bills will get paid as a matter of routine, right? Medicare, Medicaid typically process those bills pretty easily. But what happens if we have one that doesn't? Typically, that's going to be either an insurance secondary payer or an insurance primary payer. So some sort of an insurance managed care company, something like that, that's got a little bit different billing standard or whatever. Or it's going to be the resident or the resident's family. And, especially when a resident's just moved into your facility, it's important to set that expectation. Don't let it slide the first month, assuming it's going to get better. We have one that appears to be slow to pay. We need to set that expectation and deal with that issue in the first month and set the tone that that's how things are going to be done. So getting aggressive about that. What I would say is your typical collection process is going to be basically, we send a bill 30 days out. If we haven't gotten payment on that bill, co-insurance, resident responsibility, whatever that is, 30 days out, we're going to send a statement that says, you're behind. We need to catch up with this. And beyond that, typically your billing systems are going to have a system that says, we're going to send one in 30 days, and then we're going to send a progressively more, what's the word I'm looking for? Terse, aggressive, firm. How about firm? Increasingly firm letters or correspondence that say, no, really, you need to pay at 60 days, 90 days. At 120 days from the date that you bill that beneficiary, you've got to start looking at that and saying, do we think there's a likelihood? Is there a possibility that we're not? Is there a likelihood that we're not going to get paid for this? And if we're not going to get paid for it, you don't want your business office people spending time going after dollars that we're not going to get. So you may want to consider writing that off and so forth. But I would not recommend doing that before 120 days from the date the beneficiary or whoever you're paying or whoever you're expecting payment from gets billed. The reason for that is for Medicare coinsurance for a Part A stay, we can actually claim what's called Medicare bad debt. What Medicare says is if we don't get our coinsurance for a Part A stay from the resident or the resident's family or the resident's secondary insurer or whomever, if we go through a 120-day collection effort and determine that we're not going to get paid, we can bill that amount back to Medicare through the cost report and get 65 cents on the dollar. So a couple of things to take away from that. If you can get it from the resident, 100 cents on the dollar is better than 65 cents on the dollar, right? So try to get it from the resident if you can. The second thing is that 120-day window. One of the things that we've been seeing Medicare do when they audit is saying this, we want to know if your collection effort for Medicare coinsurance is different from your collection effort for other payers. So if we're billing insurance, so basically if we're trying to collect other payers for longer than that 120 days before we make a determination that money is not, we're not going to get that money or that it's worthless, then you basically negate your ability to get 65 cents on the dollar. So that 120-day threshold needs to apply to all your residents. Make sense? Okay. All right. These kids today, am I right? So one of the things that we hear a lot, and one of the things that, I'm an old guy, right? So I'm still one of those folks who, when there's something difficult that needs to be talked about or a request that I want to make or something like that, I'm not an email guy. I pick up the phone and call somebody and we talk about it. What you have to recognize is that a fair number of your residents and your residents' families are also old guys. So the email method works great for documenting the communication that you've had with somebody. But if you want to get dollars in the door, we deal with families an awful lot where the families don't think anything's really gone horribly wrong until they get a phone call about it. And that's the thing that starts the action. I would say if you're having trouble collecting something and you're continuing to send emails and they're not working, pick up the phone. We find that that's really more effective in a lot of cases. Think about that. As I said, documenting those communications is important because you may have turnover in that business office. You may be trying to collect on 40 different residents or 30 different problem children or 10 different problem children. And it may be difficult to remember what deal you've made or what expectation you set or what they've agreed to. If we don't have that document, then we don't know. I mean, what's the old adage in healthcare? If you didn't document it, you didn't do it, right? This is another one of those areas where we want to build documentation because it makes our collection effort more. And as I said before, write off your stuff, right? If you're not going to collect it, try from 120 days from the date you billed the party that you're. So the reason I say 120 days from the day you bill the beneficiary, the way this normally works is we bill Medicare for a skilled stay. Within 30 days, Medicare has paid or denied the claim, right? Within that 30-day window, at that point then, Medicare also tells us what the coinsurance is for that resident. You can sort of figure it out looking at the common working file, but not always. So we typically don't bill the resident until Medicare's paid and we know what the coinsurance is. At that point, we bill the resident, or if we've got an insurance, a secondary payer in there, we're going to bill that secondary payer. And however long it takes to get that money from the secondary payer, we reset the clock again when we bill the beneficiary. We go 120 days from each individual collection effort. So I try to bill you, and I take 120 days before I write it. It's not 120 days from the date I billed Medicare, it's from the date that I billed each individual. So we reset the clock every time. Does that make sense? So the last thing I guess I would say is make sure that we've got our procedures documented. In the business office work that I've done over my career, I've learned one thing. Do you know where the real policies and procedures are? They're in little yellow stickies around your biller's monitor. That's where your policies and procedures are. So if you want to know how things work, that's where you find it. And if you've got an inconsistency between those and your written policies and procedures in your policy manuals, probably ought to shore that up. The reason those policies and procedures are so important is that it gives, among other things, obviously it gives your process structure. We know how we do it. We know that we do these things consistently. But the other thing that it does in terms of a collection policy is it gives your biller something to hide behind. It's our policy that if these amounts are not paid within 30 days, we send the amount to a collection agency. Or it is our policy that blah, blah, blah. So it's not me being a bad guy. It's just the policy. Okay, so I'm not trying to make business office managers out of you any more than I'm trying to make accountants out of you, but we need to talk a little bit about how to manage cash receipts and how to monitor. What I would say is one of the things that you probably want to do is reconcile your monthly census. We know how many patient days we had in a month, right? We know what our private pay rate is. We know what our Medicaid rate is. We ought to be able to basically take days times rates and tie that back to what we bill. That's a way to make sure that everything is getting billed at a very high level without looking at bills for every single resident. I think the other thing that you've got to do is review your receivables or your logs for unpaid invoices. Some systems have logs that you can run that basically show what's been paid on each claim for each that's billed in each month or each time period. But the other report that we like a lot is something called an accounts receivable aging. And what an accounts receivable aging looks like is a list of your residents and their payers, and then columns 0 to 30, 31 to 60, 61 to 90, 91 to 120, and 120 and over. And it shows what's owed, or how old that accounts receivable is by each column. So what you're looking for is, if you've got an accounts receivable that you run right after the end of the month, 0 to 30 doesn't worry you too much, right? Because that's the bills that we have outstanding for, that we're sending in March for February service, right? 31 to 60 sort of starts to make us a little nervous, because at that point, that means there's something that's not paid. So you want to look at that 31 invoices that are basically from services in January. 31 to 60 days would be services in January. You're going to look at those things and you're going to sort of think, if everything in here is co-insurance, I'm okay with that. But if I've got something that's more than co-insurance, then we may already have identified a problem with a payer. And the question for the biller is going to be, what are we doing to resolve this, or what's the deal, right? If you get to 61 to 90 and past that point, those are still claims that we've probably got a pretty good shot at getting collected. We may have an issue with, I don't know, an ADR, an additional documentation request. Payers requested more documentation before they want to pay the claim. You want to make darn sure that we've responded to the ADR and sent the additional documentation they wanted, right? So, you know, a lot of things, a lot of those sorts of things can happen. I can tell you, we were doing accounting outsourcing, which is basically where we do the bookkeeping for a nursing home. It was a brand new client, and we started tying out their accounts receivable. And one of the things we noticed was that when we did this first step that I was talking about, where you basically take the days in a month and multiply it times the payment rate, $174 a day for Medicaid or whatever it was, multiply that out, and that wasn't the amount of revenue that wound up on the books that month. Well, come to find out, we asked the question, the biller quit almost immediately after they asked the question. And we opened her desk drawer and found $80,000 worth of ADR requests that nobody had responded to. And she didn't know what to do with them. I don't know. I don't have that documentation. Stuck them in the drawer. And the facility was able to recover $80,000, but it was through basic procedures like this. If you've got $80,000 standing in a 61 to 90 day column or something of that nature, you're going to want to look at that and say, I want to understand why that's out there. I think that you've got to have a monthly accounts receivable meeting where you basically, you and the administrator sit down. You are the administrator, thank you very much. You and the biller sit down together and go through the accounts receivable aging, or the billing journal or the billing logs, and say, let's walk through and look at what's not collected. You're going to have your copy of the report. They're going to have their copy of the report. On your copy of the report, you're going to write down the commitments that they make. Here's what's wrong with this claim. We expect it to get claimed. We expect it to get paid next month. We've been assured, blah, 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 right? So you're going to keep documentation on those claims, mostly over 60 days. And once you get out there, you may have to decide to write some of those off, meaning that you take them out of your billing system and they don't appear any longer in your billings. But you're going to do that, build that documentation. And then next month, guess what's going to happen? You're going to sit down again. You're still the administrator, right? I'm confused here. Yes, you're the administrator, and you're going to sit down with the biller. And this time you're going to have two pieces of paper. And guess what those two pieces of paper are? This month's aging and last month's aging, where you took the notes, right? So you're looking at last month's and saying, well, I thought the insurance company said they were going to pay, or that you had filed that you had adjusted the claim and it was a clean claim and they were going to pay, but I see that it's gone from 31 to 60 to 61 to 90. Or I thought this family said they were going to be making payments, but the outstanding balance is the same, right? How many months do you think you have to go through that process before people realize that collecting is a big deal to you, that it's important? I guess it's 2, right? So it's an accountability issue around that. And really, having that meeting takes 15 minutes. I recommend making the time for it. Keep losing the clicker. All right. Questions on billing cycles, all of that kind of stuff? Everybody pretty cool with that? I mean, it's basically common sense, just sort of some things we've seen work. All right. I want to talk about vendor and employee payments. So there is a paper trail from most purchases that we make of any size. So when I talk about vendor payments, you know, really things, this is really for things that we order and receive. So food, drugs, medical supplies, those sorts of, you know, housekeeping supplies, laundry supplies, all of that kind of stuff. This is your process that surrounds this. We start with a purchase. Oops, sorry, shoes untied and I'm going to fall, and that will give you some comic relief for the afternoon. We start with purchase order. The purpose of a purchase order is for you or your dietary manager or your director of nursing or whomever to document that it is okay to order something. I authorize us to order 500 K95 masks, 200 visors, 300 gowns, whatever. We're going to put a purchase order together to document our approval that it is okay to go seek, to go get this product. Typically, that's going to have a description of the product, a vendor, a quantity, and a price. So you're basically agreeing, I'm going to spend X thousand dollars on this purchase. So we send off the purchase order, and as if by magic, a delivery truck shows up, right? With our stuff on it. And when we get our stuff, we've got a few things that we're going to look at. The first one is we're going to look at the packing or a receiving report or something like that. And what that basically is supposed to show is, and this will be something from the vendor that they bring you. This is something that basically says, here's the stuff that I brought. A packing list is a list of, here's the stuff I've brought. We're going to review that packing list against the stuff that they brought us to make sure that the stuff they said they brought us is what they actually brought us, right? So we're going to compare the packing list. We're going to sign off on it and say, yes, I verified that we got X cases of this and Y cases of that, and that's what's on the packing list, and so on and so forth. We're going to document that. We are also going to compare the stuff they brought us to the purchase order. Why would we do that? Make sure you're not getting a different quantity. Both you guys said it, just 2 different ways. Making sure that we're not getting a different quantity of stuff than we asked for. If we've got too much, we're going to be billed for more than we approved, which is bad. If we got too little, we probably have to make some sort of arrangement if that was a supply that's needed this week, because we don't carry a lot of stuff in inventory. We need to make arrangements to get more of whatever that thing is, right? So now what you've said is, I've approved a purchase, I got the stuff, and the stuff that I got agrees to the packing list. Guess what happens next? We get an invoice, and the invoice says we are billing you for this stuff. If you've compared, so at this point, what we're going to do is look at that invoice, and we're going to look at the receiving report. The receiving report says, here's the stuff we got, right? I'm going to compare that to the invoice to make sure that I'm getting billed only for the stuff I got, right? So we're comparing those things. When we're done with that comparison, we're going to document approval to pay that invoice. And what happens with that invoice then is that it gets entered into your accounts payable system. And off we go. And then basically it's a matter of when do we have the cash or what's our arrangement with the vendor to pay that. So that's the process from placing an order, the paper trail, basically all the way to getting it into your accounts payable system and recognizing that we owe the vendor something and approving the amount we owe the vendor. Now, the thing is, you sometimes get something called a statement. And a statement is an entirely different. So an invoice is a list of the stuff that you got and the amount that you expect with a request for payment. A statement is a list of invoices that the vendor shows as not being paid yet. We never, ever, 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 ever pay from statements. We pay from invoices. The information that goes into our accounting system should be based on the invoices because that's got the detail that shows us what we actually got. We never, ever pay from statements. That doesn't mean statements aren't useful. Because when you get one of those statements, if there's you sort of look through it and you say, all right, I've got invoice 2, 3, and 4 in my accounts payable system. So I show that I owe those. Invoice 5, I don't have in my accounts payable system. Did I miss an invoice somewhere? Invoice number 1, I sent a check for last week. It just hasn't, they crossed in the mail. People still use mail? I don't know. There's a timing difference. Let's just say that. So invoice 1, yeah, I know I paid that. They probably just haven't seen the payment yet. 2, 3, and 4, I show I agree that I owe those amounts. Invoice 5 is news to me. So instead of paying invoice 5 from that statement, we're going to call and ask for the invoice. Maybe the reason you don't pay from statements is that those invoices are part of your control process to say we got the stuff that we ordered and we're approving those for payment. If we don't have an invoice in our system, it's possible we're being billed for something that we haven't received yet. So it hasn't been through that. It hasn't been through that process. So that's about all they're good for. Okay, that's your vendor paper. All right, let's talk about inventory right quick. So inventory is something that we're supposed to sort of spend a little time on. It's been my experience that most nursing facilities don't carry a lot of inventory. So you might want to know if you've got a supply closet or a stock room or a storeroom, there's inventory in there. And that's sort of what you want to look at. And the idea is that if we have more stuff than we can use in an immediate time frame, we carry that as an asset and then we basically expense it or move it onto our income statement as we use it. Which is not to say that inventory isn't an important thing to monitor. Our recommendation is that when when that truck magically shows up with the receiving report, we try to receive those goods in a storeroom or an area that's not where we've got a bunch of residents running around and nurses running around trying to get that into the back of the facility. If you've got a storeroom or a more quiet receiving area that you can use, typically that's better. We think storerooms should be locked to prevent shrinkage. Shrinkage means theft. So keep those storerooms locked as best you can. We think inventory should be counted periodically. Most folks do it once a year. Right now, you guys have probably got epic stores of PPE. Probably not a bad idea to have counted that about 2 months ago, right? So we know what's in there. When I say periodically, I don't know that I'd count inventory more than once a year unless you've got a problem with it walking off. If inventory is walking off, if you count it periodically, you have what I call a psychological control. People think that you're looking at it and monitoring it, and as a result, your theft can actually shrink just because you're doing a periodic inventory count. Yeah, and we see this sort of thing happen. I mean, not receiving goods in a location or not paying attention to it. I actually have a client over in Arkansas. This would never happen in Oklahoma, I'm pretty sure, but who knows? That basically it was known in the community where this nursing home is that there was a chicken sale every Tuesday after the Benny Keith truck showed up. So what would happen is the dietary manager would order extra chicken paid for by the nursing home itself and was selling it out the back door of the facility and not sharing the profits. So keep an eye out for the Tuesday chicken sale. There's another piece of advice for you. You can't make this stuff up. All right, so that's vendor payments. The other thing that I think we've got to talk about and spend some time on is payroll. So if I were going to rank order this, the first thing you're going to want to spend your time on is billing, revenue, getting cash in the door. The second thing, and the second biggest expense you've got, and the second probably most subject to misappropriation, shall we say, is payroll. And part of it's because payroll is pretty complicated. If you think about what's in there, you've got, just think about your own paycheck, right? You know what your hourly rate is or your pay rate. You know we've got to report hours. If you're not on salary, if you're an hourly employee, you've got to report hours. We may have non-productive hours, so we may have some vacation that we're earning or some sick time that we can use, or we may have holiday pay or something like that. We may have a shift differential. We may have an overtime rate. We may have all sorts of things of that nature. Your deductions and withholdings, facility may buy uniforms and then you pay them back. So there's a uniform deduction. Or on the contrary, there may be a uniform allowance where you get paid a certain amount to buy your own uniforms. There's health insurance, and what elections have you made for that, and how much are you having withheld for health insurance? And there may be a 401k or some sort of retirement benefit, possibly. We don't see a lot of that, but sometimes it's in there. So you think about that, federal and state income tax, and remember that you guys make an election when you fill out that W-4. When you start a job, you basically say, here are my standard, here are my exemptions, right? So that sets your tax rates. There's your share of Medicare and Social Security and the employer's share of Medicare and Social Security. That's a lot to keep track of, right? So there's a lot in there. So your payroll process, a lot of this is automated now. The big picture, the broad strokes still sort of work like this. We set up all of those things in our pay system, our health insurance rates and our deductions and our tax rates and our hourly rates and the shift differentials that might apply to me and whatever that might be. So that all gets set up in the payroll system. And I got to tell you, if that's not right, none of the rest of this really matters. Everything, it's going to be wrong. So one of the things that we recommend periodically doing is basically pulling an employee's file, pulling up that employee's data in the payroll system and just checking that against the employee file to make sure something's in there. Every story I tell is based in fact that the names have been changed to protect the guilty. But we've seen things over the years where the payroll manager's buddy might have an off-cycle pay rate increase, right? That's unapproved or unauthorized. So looking at payroll system reports to look at changes in pay rates and those sorts of things may be useful as well. So we basically accumulate hours. We use a time card or a timesheet or Chronos. We tap our badge in or however that works, whatever the process is in your building. And that's how we get the hours in. But what happens? People forget to clock out. People forget to clock in, right? So there's a manual process that we've got to go through for each department to say, all right, we've got these hours, but do they make sense based on what happened? There's no way that this employee worked a 48-hour shift straight, right? Or there is a way, but it's unlikely. Did that actually happen? No, we probably forgot to clock out or something of that nature. So that's what that hours approval thing is about, looking at things and making sure they make sense. Once that's processed and the department heads have approved, we process it for payment. And then, in the good old days, the checks were signed by the administrators. We see about 50-50 direct deposits now, where people aren't getting paychecks. We see systems set up where people will get, the nursing facilities, it seems like, that are using paychecks still, like a paper check, are basically doing that to make sure people show up for in-service. They'll set an in-service on payday. And if you're not there, people will show up for that check, so they might as well do the in-service while they're there, kind of thing. We see it done for documentation, turning that in. And we also see a policy where we do a paper check on termination to make sure that we get the keys, card, and anything of the facilities that we've issued to the employee back. So, but we're seeing a lot of facilities going to a direct deposit. We do see a fair number of employees that still don't have bank accounts. But we're even seeing a situation now where some of the payroll processing companies are offering a card that basically it's like a debit card. So basically a debit card without a bank account. The pay goes onto that debit card, and the employee's got it available to use without actually having a bank. And you never have to deal with a check if you don't want to. But that's not to say there aren't compelling reasons that you would want to deal with it. All right. So payroll, as you may remember, is the biggest expense item that you have. And so it's something that needs to be managed pretty closely. And whether that is, as I suggested earlier, looking at your hours per patient day and your staffing levels and making sure that we know what level we're staffing at. Based on this census, we should have for this shift, 1 RN, 1 LPN, and two aides. And for the night shift, maybe it's 1 RN and an aide, or, depending on what your census is, but making sure that we drive that payroll cost and that staffing level based on your census and keeping an eye on that. Now, I'm old and cynical. I recognize that about myself, but I will tell you that it's been my experience that the scheduler and the nursing staff, the dietary staff, housekeepers, tends to make adjustments very quickly when the census is going up, right? We need more help. But in this environment that we're in right now, where in some cases our census is starting to taper off, we're not seeing those downward adjustments get made. So we're paying employees based on a census at this level, but our census is actually at this level. So making sure and monitoring census and making sure that we're making those adjustments when we have a decrease in census as well as when we have an increase, managing both ways. Overtime and contract labor, we're seeing a lot of that right now in the facilities that we work with, because of call-offs, because kids being virtual in school, variety of factors, because of waiting for a negative COVID test. We just see any number of reasons why there's more overtime in contract labor than there's been in the past. I don't think overtime and contract labor are necessarily a bad thing, but I think the suggestion I guess we have is if you're going to use them strategically. Use them to cover shifts that nobody wants or to relieve key employees. People that you sense are getting fatigued, use them in that way. The simple reality is overtime is exhausting and expensive. Contract labor is even more expensive. And the thing that you lose with that is that connection with the residents. We're just here to go through the motions, and you lose some efficiency in that process as well. So, trying to use it strategically. And as I said before, set an expectation and measure against it. And I would watch it every month. Keep an eye, close eye on it. Guys, it's post-lunch and I know you're feeling it. I can see it in your eyes. We're going to take about a 10-minute break, and then we're going to push on to the end after that. How's that sound? So back here at 1:45.
This conference will now be recorded.
Okay, the next section I've cleverly titled Other Accounting Stuff. And this is some of this stuff is kind of nasty. So stick with me. We'll try and walk through it and make sense of it. This is that third semester of accounting when I almost gave up the profession in favor of something entirely different. But the thing that we need to really spend some time on first is capital assets or property and equipment or fixed assets, they're sometimes called. You'll see all of that stuff on your books. And what capital assets are, or fixed assets or property, plant, and equipment, what those are sort of big ticket items, expensive items that are expected to last more than one accounting period. And so, for example, you buy a van for your building, right? When we put that on the books, we don't use the whole van up in 1 year. Well, I mean, depending on who's driving it, but we don't use the whole van up in a year, right? We expect it to last a while. So what we do is something called depreciation. And what depreciation does is says, if I spend $40,000 on a van for my facility, I expect to get 10 years worth of use out of that, we're going to expense or put on our income statement a tenth of that asset every year until we're ready to trade it in. And what that does is basically recognize an expense for that asset over the period that we use it. Conceptually, that's a little bit hard to get your mind around, but the big issue is this. In your facility, there's probably, or should be anyway, what we call a capitalization policy. And what that says is, if we have what we call a long-lived asset that's got a useful life of more than, this is going to be in your policy, 3 years, 4 years, 5 years, whatever that is, and costs more than $5,000 or something like that, whatever your policy is. If I have an asset that's got a useful life of 3 years or more, and it costs me more than $5,000, instead of just running it through that supplies line on the income statement, everybody remember kind of seeing that in there, so the whole thing goes through. I'm going to spread that asset over the period that I'm going to use it and use the depreciation line instead. Okay. So what we're basically doing, big picture, when we talk about depreciation and property, plant, and equipment, what we're talking about is expensing that asset, or recognizing expense for that asset, or matching the expense of that asset over the period that we expect to use it. So how does that work, right? That's kind of the burning question. And in your PowerPoint materials, you've got this little slide that basically says, if we decide we're going to buy a computer that costs $2,000, okay? I want to talk a minute about salvage value. This is another one of those things that we don't see out in the real world. Everybody assumes no salvage value, but the idea makes sense, sort of. What we're recognizing is at the end of that useful life, that computer may have some value. At the end of 10 years, that van is not going to have zero value. It may be worth $2,000 or something, right? So since we probably have the ability to trade this thing in for $200 against a new one or something like that, we're going to say that it has value at the end of the period and it has value at the beginning. So we're only going to depreciate or recognize as expense the difference between what it cost and what we expect it's going to be worth at the end of its life. Okay. So instead of depreciating $2,000 over 4 years, we're going to depreciate $1,800 over 4 years. So I put a little example together that I thought maybe will make that a little more clear. I hope the folks participating at home can sort of see this, but this is the same example. So what we've said is, and you might look at your income statement. There's a depreciation line on your income statement. On your balance sheet, there's a capital assets line, and I think it's called accumulated depreciation. So those are the financial statement elements that we're going to talk about. And the assumption we're making here is that we've only got one asset. So we'll kind of show how this works. So at the beginning, of the period, let's say that we bought this asset at the beginning of 2020. Okay, we bought it January 1st of 2020. That just keeps the numbers nice and easy. And we paid $2,000. And we think, based on the last computer the computer that we traded in on this one, that at the end it's going to be worth $200, right? So the amount of expense that we're going to match, if you will, or depreciate is the difference between those two, or $1,800. Everybody with me so far? It's worth $2,000 now. In 4 years, it'll be worth $200. So we're only going to recognize $1,800. And we say basically we're going to use that asset evenly over the next 4 years. So every year, we're going to run through that depreciation expense item on your income statement, $450. After 4 years, we've got $1,800 that's gone through our income statement, right? So at the end, 4 years at $450 a year over there. All right. That's the income statement side. What happens on the balance sheet is a little bit different. So on the balance sheet, we've got $2,000 because credit, cash, debit, capital assets, right? For $2,000. At the end of the first year, we recognize $450 of depreciation, right? So when you look at on your balance sheet, you've got a net number, a net property and equipment. What's in that number is $2,000 minus the $450 of depreciation that we captured. So our net, we're carrying that computer on the books now at $1,550. So it started out at $2,000, but at the end of the year, we've taken $450, and our net is $1,550. Let's go to year 2. In year 2, we expense another $450, right? So that's what goes in our depreciation expense. Now we've got the $450 in the first year and the $450 in the second year. So we've expensed now over a 2-year period, $900. Anybody follow that? That's our second. On our balance sheet, we've still got that same $2,000 in capital equipment, capital assets. Now we've got $900 that we've run through the income statement. And our net book value, or our net value on the books now, which is capital assets less accumulated depreciation, is $1,100. So 2,000 minus 900 is 1,100. You can see where this is going, right? Just because I'm getting exercise now and I'm loving it. For the third year, we take another $450. Now our cumulative is 450 plus 450 plus 450. So we've taken 1,350 of that asset as expense, right? Over a 3-year period. We've still got the same asset cost, Our accumulated depreciation is 350. And what we've got left on the books is 650 bucks. Year 4, we take another 450. Now our cumulative is 1,800, that number. So it's what we call fully depreciated, right? We take our 2,000, less our accumulated depreciation is $200. That $200, this is the arm that I got shot at yesterday. I'm going to have to go right-handed for a while. It hurts. $200 is what we've got on the books at the end of this 4-year period, right? We've got an asset worth $200 on the books because we took little bits of it, we nibbled away at it over 4 years. And that's what we said the salvage value was, right? So it's on the books for what we said it was worth at the end of its useful life. That's depreciation. Is that crazy hard? Got it? It's because I'm such a great teacher. I bet that's got to be it, hasn't it?
So is this so say it's a $2,000 computer, maybe it was a $500 cell phone or something. Is this for tax purposes? Is that why we do the depreciation? Is that what this is for?
Well, it's for both things because, I mean, for tax, yes, we do take the depreciation and what the IRS says, the IRS lets you do something called accelerated depreciation, where in the first year, you might take $900
Mhm.
and then a lesser amount in each of the subsequent years.
Okay.
Because, it basically recognizes that you drive the new car off the showroom floor and it's worth less than it was when you started by a lot. And then it sort of tapers off. So the IRS lets you do that. But basically what the IRS says is we don't want you taking as expense the full amount of what you purchased if it's over a certain threshold.
Okay.
So it keeps you from being able to manipulate income, taxable income, by buying big ticket items.
Okay.
But the other thing is that from an accounting perspective, it does recognize that that asset isn't just going to be used in the period you bought it.
Okay.
So to circle back around on that, your policy should say we capitalize everything over $5,000, meaning if it's less than $5,000, we just put the whole thing through the income statement. And it has to be over $5,000 that we purchased. And it has to be an item, like, yeah, a physical asset, right? Yeah, that's exactly right. And the reason that's important is, I probably am exposing too much of my neuroses here a little bit, but I'll tell you that I have the same trash can in my office today that I had in 1993 when I started with my company. That trash can is a long-lived asset, but it's a small enough dollar value that we wouldn't capitalize. So you think about it in terms of big ticket items and useful lives. That's depreciation, folks. Now, I will tell you one other thing that may be worth knowing. A computer is a pretty simple example, right? Because you go, you get it, you set it on the desk, you plug it in, and it's off to the races. But if you think about like building improvements, let's say we put we recarpet our facility. What you capitalize for carpet or roof or HVAC equipment or whatever that is, isn't just the materials cost, it's also the labor cost to get it put in place, right? So it's the whole amount of the bill, not just the materials. It's the same logic, right? Because you don't expect to have to pay that labor every year. It's a one-time, not one time exactly, but an infrequent cost, if that makes sense. The other thing to bear in mind is if you have like an insurance proceeds, tornado blows your roof off or hail damage or something like that, when you set it up on the books, you're typically going to net the insurance check out of the amount you capitalize. So you put it on the books at your net cost. So a couple of little finer points there. The bigger issue though is getting the big concept. We're basically taking a big ticket item that's got a life beyond 1 year and we're recognizing it over an estimated period that we expect to use it. So it hits the income statement over a series of accounting periods as opposed to going all over one. Okay? That's half a semester by itself right there.
Question.
Yeah.
So where it says accumulated depreciation, would that 945,000, would that just be one item or all the items in that one building that have that depreciation?
What a great question. So one of the pieces of the accounting records that I didn't tell you about, it wasn't even on my list, is something called a plant ledger or a property and equipment ledger or a depreciation schedule. And what that depreciation schedule will do is list out each one of these assets. So computer, a facility, a van, 25 beds, whatever it is. It'll list those out and it'll do this calculation for you. And so the capital assets number on your balance sheet, that's going to be all of the cost of the assets. So at basically what we paid for. The accumulated depreciation will vary depending on, you know, a van might be 5 years, a roof might be 15, a computer's 4. It'll just, those lives will vary. And the purchase dates will vary. So it's basically this calculation for each asset. As of December 31st of 2020, here's how much accumulated depreciation we had at that point in time. So it's as of one time. So it's all of your capital assets, basically. The short answer to your question is yes, it's all of it. Yes. So multiple assets, yes. It seemed like there was something else. You reminded me of something and then I completely squirreled on it.
Sorry.
No. Yes, a couple of things. So one of them is land. We don't depreciate land. The presumption is that land has a value now and it has a value in the future and that doesn't go down. So there's no depreciation on land. The second thing is that when we do depreciation, we depreciate that based on our cost. So if we bought a nursing home 40 years ago, and we maintained it well, we may have paid $350,000 40 years ago for a 60-bed nursing home. It may be worth $3 million now, right? We never on our books adjust that up to $3 million. It always stays on our books at cost, so we never adjust to value. If you sell the nursing home to somebody after you and they pay you $3 million for it, it goes on their books at $3 million. We don't ever adjust it on our books. Cost. I think that's what I was thinking of. So cost, land doesn't get depreciated. Okay, more fun. Let's talk about internal controls. This is the part of the day where I teach you how to rob your company blind. There are 3 types of responsibilities. When we talk about internal controls, what we're talking about are processes that are in place or systems that are in place or structures that are in place to protect your assets. And if we think about what our assets are, generally what we're talking about is cash. There are 3 types of responsibilities as it relates to accounting. The first one is custody of the asset. So can I actually physically lay hands on it? If I take cash receipts at the front desk, I have custody of the asset. If I have the ability to write and sign a check, I have access to the asset. If I can approve a payroll, I have access to an asset, right? If I can enter information and approve a payroll, I can cause an amount to go out, obligate an asset. So we have to kind of broaden our definition and how we think about access, but access is one. The second one is accounting for assets. So the reporting. So, posting transactions. So when we think about cash receipts, if I have access to the cash comes in, and I can lay hands on a check or a payment or something of that nature, I have access. If I post those payments, that's the accounting piece of it, right? The third piece of it is reconciling. And it's really weird that we have reporting and reconciling as two different controls, but they are. So when you talk about reconciling or monitoring, that's agreeing the bank statement back to the financial statements, or making sure that on a given day that the cash receipts that we got in match what got posted into the general ledger or got posted to the cash receipts journal. Tying out records. So basically, the process of agreeing or reviewing outside information to inside information or monitoring. So you've got handling access, you've got accounting, which is the bookkeeping, you've got reconciling, which is sort of another process to sort of quality check your accounting, if you will. So here's the deal. If we have an employee that has access to an asset, in a perfect world, that employee would not have access, would not have the ability to do the accounting or the monitoring. If an employee has access to the asset, using that broad definition we just talked about, they should not be able to do the accounting for it. They should not be able to have any monitoring responsibility. Here's why. So let's say that our structure is that our business office manager, I've been picking on him all day, why stop now, right? If our business office manager receives resident payments in check or in cash and prepares the bank deposit, so makes the list of the checks out on the bank deposit, staples or paper clips, all that stuff together, stuffs it in the bank bag and makes the deposit, and posts the payments, right? So we've got access, right? Because this person is laying hands on the asset. And we've got accounting because we're posting payments, right? We've got two duties or two responsibilities that are incompatible. What keeps that individual from taking cash and putting it in their pocket, falsifying the deposit ticket, deposit slip, and posting a payment or an adjustment into the accounting system? If you post an adjustment in the accounting system or the cash receipts journal, that balance disappears and nobody gets billed for it. So I know what's going on in your minds. What you're thinking to yourselves is, yeah, we don't get much cash, so that's not a big deal, right? But we do get a fair number of checks. Yeah. You would not believe what happened. Several years back, this has probably been 10 years ago, we had a business office manager for a nursing facility that, let's say the nursing home was called Murphy Manor LLC. She set up a corporation called Murphy Manor Inc. It was an S corporation, and opened a bank account in the name of Murphy Manor Inc. She would periodically get checks at the nursing home that were made out to Murphy Manor. And guess what? The bank didn't give much of a flip whether it was Murphy Manor LLC or Murphy Manor Inc. She was able to deposit those checks in her own bank account for her corporation and post adjustments so that nobody was ever the wiser that those dollars were not going to the appropriate accounts. People are creative and not necessarily in a good way. So you can see why having these conflicting duties is a bad deal. So how do you solve that, right? We're not in a position right now where we can probably hire another person. We're all financially cash strapped. We sure can't just hire one person to post payments or something like that. But one of the things that we've seen work in a lot of places is that the business office manager doesn't accept cash. Basically, receptionist or whoever's working the front desk, the administrator, whoever, they'll take the cash when it comes in. They'll open the mail. If there's walk-in cash, they'll take that. And they will prepare a deposit slip. And they might make a copy of the check. But they'll prepare the deposit slip, and the payments get posted from the deposit slip or the check copies instead of that person actually ever laying hands on the document. So here's another one that happens a little bit. So let's say that this business office manager, in addition to doing revenue cycle stuff, also does payment stuff. So let's say that the business office manager prepares checks to be sent to vendors, and then the administrator signs the check, and the business office manager stuffs the envelope and mails it. Do we have access to an asset at the point where I've got my hands on a signed check? Yeah. Right. And then the business office manager prepares a bank reconciliation. And when you do the bank reconciliation, I want to let you know that one of the things that you're supposed to do with that process is, you have those enclosures with the bank statement. You flip through those canceled checks or those canceled check copies and look for anything that's a vendor that you don't know or anything that appears to be an altered check. I mean, I swear to goodness, you could basically white out a payee and write in crayon your own name, and the banks would process the check 9 times out of 10. I mean, it's just not something that they're wired to look for, right? So what basically happens is, in this circumstance, the business office manager takes a signed check, changes the payee and cashes it, or runs a check through that is to to herself or to a company that she owns, or to a relative's organization or a friend's company, or any of those sorts of things. The administrator doesn't notice that and ask the question, because let's face it, you've got plenty of stuff to do without dealing with, is this a good vendor, as you go through and sign checks, right, or review those check processes. So when the bank statement comes in, basically, once you've got the administrator to sign that check, it goes out, and the only person, if this business office manager is doing the bank reconciliation, the only person that ever sees that again, business office manager, and when that comes in, they just ignore it. And I might make an arrangement with the vendor to pay in smaller payments over time. And if it's a small payment to a known vendor, chances are the administrator is not going to go back and look at invoices, right? They're just going to look at the checks that went out. So again, you've got access, right? But you've also got monitoring responsibility, because they're doing the bank reconciliation. So one of the things that we might recommend is to periodically, if you're the administrator, open the mail. When the bank statement comes in, open the mail and just flip through it and see if you see anything that appears to be written in crayon, or a vendor that you don't know, or just periodically flip through it. Again, you may find something, you may not find anything, but you might let the people know that you want to see it and you want it unopened. Like, I don't want you to, if it comes from the bank, I don't want you to slit the thing open, and I want it sealed and in my hand. That's another psychological control, right? Because we may not find anything, but if they think we're looking, you may be able to fairly easily avoid this sort of situation. Best thing to do, though, is to have the business office manager prepare the checks and stuff the envelopes, but have somebody else look at the bank reconciliations or do the bank recs if they can, or have the variety of ways to solve that problem. But you have to get those duties segregated. Okay, now on to management accounting. So we talked early on about the accounting that we talked about earlier was accounting to look at how our facility has done or did in the past, right? Management accounting has a little bit different view. It's about looking at how your facility might perform in the future. If we make a change, what does that happen, or what impact does that have on our financials? So to get that down out and out of the way, we've got to do a couple of things with terminology, and one of them is variable and fixed costs. So when we think about variable and fixed costs, variable costs basically fluctuate. They go up and down when our census goes up and down. Variable costs go up and down when our census goes up. So our cost per patient day doesn't change. And it doesn't have to be a 1-for-1 ratio. When you have fixed costs, they don't. The cost basically stays the same whether I have 70 residents or 50 residents. So let's run through a couple of examples of that. And again, put you 5 here that are live on the spot a little bit. Nurse aid costs. Do you think that's fixed or variable? It should be anyway, right? All right. Director of nursing costs. Fixed, because that shouldn't change.
Dependable on how long they stay.
Yeah, right. So okay, so those are the easy ones. Rent, right? Rent fixed. Maintenance. You say variable. So we have more maintenance. Okay, so let me say maintenance personnel. Fixed or
Oh,
okay. Housekeeping personnel. I'm hearing fixed.
I would say it's a variable though. The more residents you get, the more housekeeping staff I have to keep up with it.
Yeah, I think I'm inclined to say it's mostly fixed, but at a certain level, it's what we might call a step cost, where when you add 1 or 2 residents, it doesn't go up, but if you add 10, you're going to add one. I think dietary is probably the same. So my point in saying that is these are not, the lines aren't always clear cut. You sort of have to, when you think about fixed versus variable costs, you think about what is it mostly? Is this mostly a fixed cost, or is this mostly a variable cost? So when we talk about management accounting and thinking about the impact, the financial impact of changes that we might make to the operations, one of the things we want to know is if we're adding a cost, is that a fixed or a variable cost? In other words, if it's a variable cost, that's a cost I'm going to have to manage, right? We talked about staff, direct care staff. That's a variable cost, but it's only a variable cost if you make it vary, right? It isn't going to vary by itself. You have to make adjustments. So it's a cost we have to manage. All right. Fixed and variable is a useful concept. Direct and indirect is not, but it's in the test, so we're going to talk about it. So direct and indirect cost. Direct costs are costs that relate to kind of directly to your revenue stream. So things like direct care cost, your nursing cost, your aides, your LPNs. Indirect costs are what you normally would consider overhead costs. So like the administrator, housekeeping, maintenance personnel, facility repairs, utilities. Those are things that are indirect costs. Again, the distinction between direct costs are that they are directly tied to producing revenue in a manufacturing world. I don't quite know how to translate that to skilled nursing, but that's the concept.
What is it like, okay, direct is whatever pertains to patient care, right? Like pharmacy.
Yeah. So your ancillary costs.
Right.
Yeah.
Like all of the, okay.
Yeah. And so the question that I always get is, well, okay, but what about dietary? We're required to furnish meals. Is dietary a direct cost or an indirect cost?
Say it's a direct cost.
Yeah,
You have to keep them alive.
well, that's right, but but by that logic, utilities are direct cost
Yeah,
because,
true.
so I don't know the answer to that question. Like I said, it's not a useful construct in the business that we're in. It's great in manufacturing, right? Because we know what our materials cost are to make a widget. We know what it costs to put a worker on the line, and the guys that are processing the payroll and running the plant or overhead. We can see those distinctions pretty starkly. But in our business, we know nursing is, we know, thank you for reminding me, ancillary costs are. But beyond that, I don't think we're sure what's a direct and indirect, especially again, when you look at housekeeping, and dietary is the worst one because I don't know. And my thought on that is I don't care because it's not a useful concept for us. I think I'd err on the side of it being variable. God, that's not one of the options on the screen. I think I'd err on the side of that being a direct cost. At any rate. So the next thing we need to talk about is the break-even point, and this is a brain melter, okay? This is a brain melter. I'm going to give you the concept, and then we're going to go through more math. There is very little depreciation involved in the math, so you're going to be happy about that. But the idea is this. There is a certain, okay, so our revenue is a certain amount per patient day, right? Our variable costs are a certain amount per patient day, right? Variable costs per patient day does not change because by its nature, it changes when the total amount changes when our census changes. So the per patient day amount doesn't change. The break-even point is the point where you have enough resident days to cover your fixed cost. Because your fixed cost doesn't change, right? So if you think about it, oh God, this is brain melting, I promise. It's melting mine right now, and I understand the concept. But the idea is that your revenue per patient day doesn't change. We get paid for everything that we do on a per patient day basis, right? Mostly. Our revenue per patient day doesn't change. Our variable cost per patient day also doesn't change, right? On a per patient day basis, it doesn't change. Our fixed cost per patient day does change because the cost itself doesn't change, but the days change, right? So maybe to illustrate that point, we're going to finish strong, people. Break even. Here we go. All right, so here's what I'm talking about. I hope you guys can see that, sort of. So here's the concept. Our revenue per patient day is $150, right? If we have 10 days, it's $150 a patient day. If we have 10,000 days, it's $150 a patient day. Because when our census goes up or our patient days go up, our revenue goes up with it, right? They go together. And let's say that our direct care staff and food and medical supplies costs are also what we consider variable costs, right? So as our census goes up, we spend $12 a day, a patient day, or whatever I said, $8 a patient day on food. If I have one day, it's $8. If I have 2 days, it's 16. If I have 3, and now we've challenged my ability to do math without a calculator, but they go up in lockstep. They go up together, right? So what we're basically saying is, at some point, our revenue per patient day is $150. Our variable cost per patient day is $71, right? So on every patient day, we're generating a margin or a net income of $79 when we compare our revenue to our variable cost. So if I have 10,000 patient days, I'm generating $790,000. If I have 10,000 patient days, I've got $1.5 million of revenue, and I've got $710,000 of variable expense. So I've got $790,000 left over after I've covered those variable costs. And because the revenues and the variable costs both vary or both change with my amount of census, that gap between those two numbers doesn't change. It's always $79. It's the nature of variable cost. Are you tracking with me? Kind of, or are we lost? Let's ignore this part. So if for every patient day, and I know this isn't perfect, one patient day is an absurd thought, right? 10,000 patient days, that's a little less absurd. But let's say that my margin on variable costs, meaning for every patient day that I have, I'm bringing in 150, and I'm paying staffing, food, and medical supplies of $71. If I add 10 patient days, I get 10 times 150 in revenue. I get 10 times 71 in expense related to variable expenses because those things travel together, right? So I've got a $79 a day margin. The question is, how many of those $79 a day margins does it take to cover my fixed cost? Okay. So if I say my fixed costs are $1.5 million, every patient day generates $79 of margin. If I divide $1.5 million by 79, I get 18,987 patient days. Clear as mud, right? I can see by the looks on your face that you're totally into this. All right, so maybe the thing to do is to back solve. I don't know about you guys, but in algebra, I would work the problems backwards sometimes to see if it worked, and it kind of helped things make sense. So let's back solve it and think about it this way. If our revenue on 18,987 days at $150 a day is $2,848,000, right? I basically said my break-even point is the point where I am at zero. The minimum number of patient days I need is 18,987 based on this math. So to prove that out, what we're going to say is I'm going to take 18,987 times 150, and that gives me revenue of 2.8 million, 2,848,000 and change. Everybody understand that? My variable cost is the same, regardless of whether I have 12,000 patient days or 30,000 patient days on a per patient day basis. When the cost goes up, when the patient days go up, the cost goes up too, so they travel together. So my 18,987 patient days times my $71 a day expense is $1,348,000. So that's my variable cost. My fixed cost is this amount, 1.5 million, right? So at 18,987.34 resident days, my total expense is 2,848,000. My total revenue is 2,848,000. So I've got a margin basically of zero. Guess what? If my patient days are 18,988, I made $79, right? Because after this point, I get to keep all of that because I've covered my fixed cost. Once I get to 18,709 transposition, this is something that you really want to see in your account, by the way. 18,987 patient days, that's the point where bottom line is zero. That's right. Basically, after that point, you get to keep all of the margin on your variable cost. So it works. I'm going to be quiet and let you guys think for just as long as I can stand. Oh, please do. I'd be disappointed. Would you like me to pose with it? Yeah, this is another one of those brain melting concepts.
So is it your accountant that does this or your CFO that typically does this, or is it the outside agency that does this?
You know how often I think about this? Twice a year when I teach this class.
Okay. So you're not doing this every day with your clients?
I do it, this is sort of, I do it sort of intuitively.
Yeah. Well, after this meeting.
It's not as formal as, the process is not quite as formal as this, but I do it intuitively. So again, once you've covered your fixed costs, that margin on variable costs is yours.
Yeah.
So that's the whole idea. The concept again is called break-even point. And basically what you're trying to solve for is how many resident days do I need, or how many patient
To
days do I
pay, to
need
get profit.
to get profit. And the way you get profit is by having enough of those margin units,
Yeah.
enough of those $79 to cover your fixed cost. Beyond that, your fixed cost doesn't go up anymore, it's fixed. Okay,
That was a lot.
that was a lot. You ain't seen nothing yet. Well, it's one of those things that you've got to kind of build the concepts and get in the frame of mind. And then there's budgeting, which again is something that we all should be doing, but that very few of the nursing homes that we work with actually do. And it's a process, but you're going to start to see elements of, I sort of like the process because you're going to see elements of fixed and variable cost. You're going to see elements of understanding environmentally where you are. You're going to see aspects of employee buy-in to this. So there's a lot here, and there's a lot here to like. And you do have a budgeting handout, if you will, or whatever we call a handout that's actually not given to you on paper. You do have one, and that's actually where we're going to spend most of our time. But the idea is, so budgeting, remember I said early on, is the process of setting expectations for financial performance for a future period, and then measuring how well we do against that expectation and making sure we understand why those differences exist. And you'll see elements of that as we go through this process. All right, so when you start a budget, the first thing you do is this whole process of setting an expectation. And I think the first thing we look at is assessing the environment. What's the world that we live in look like right now? So if I'm assessing the environment right now in long-term care, what are we thinking about?
Census.
Yeah, because it's down.
It's down.
But I've actually looked at this. I compared, because I am just this nerdy, I actually looked at PBJ data for December 31st of 2019, because it's got census days there.
Yeah.
And I looked at PBJ data as of, I think it was January 3rd of 2021. Oklahoma's down 15% statewide. 15%. Our occupancy went from 69% to 54% in a year. And so one of the assumptions or the environmental things you have to look at is what's the impact of the vaccine, for starters, right? And can we, as an industry, make this case that we've gone from being the scariest place to put a loved one to the safest place to put a loved one because our employees, I don't know, what's your vaccination rate look like for employees?
We have about 60% participation.
60%? Yours is what, 40? I was talking to one of my partners in our New York market. I don't know if you guys know what New York has been like, but it's been awful. I mean, they were in a position, and we have nurse consultants up there that are helping with infection control processes and that sort of thing. And they said, you know, starting about April, May in that area, they couldn't, they had to find a place in the building to store bodies because they could not get them out. We were talking to them about vaccination rates for employees. Vaccination rate in New York is 30 to 40% for nursing home employees in an environment like that. It just blows my mind. So, you know, making that argument, we look at some of the expenses that we've incurred. We've paid some bonuses in a lot of buildings. We've paid hazard pay and those sorts of things. Do we think that's all really going to go away after the pandemic's over? Or have we reset our salary? So think about that from an environmental perspective. That's the sort of thing that comes to mind. And there are probably other factors. We got our, you know, when the waivers expire that we're getting that allow us to bring Medicare people, you know, basically certify people as Medicare without sending them to the hospital. When those expire, what happens to our skilled census? And those are much better payers than our Medicaid payers. And, you know, what does capacity in the industry as a whole do to us in terms of, you know, does my facility have an advantage over a facility down the street or facility in the next town that I can capitalize on, or am I going to be playing catch up? Think about all of those things. When you do a budget, those are the sort of things that come into your mind. What's the next year look like? So when I say environmental, assess the environment, those are the kinds of things we're talking about, thinking about. You know, determining your objectives. I mean, do we have a 3-year plan to get our facility from where we are now, probably down 15% census, to restore our census over 3 years? And thinking about our break-even point, are we below that? And how do we ramp that census back up? And what's our process for census development? How long will it, if we ever, can we ever get back to where we were? You know, you've got this upcoming baby boomer bulge in the population. So, you know, maybe those things offset, I don't know. And then you project out your revenues and expenses. You make an operating budget. We're going to actually go through that exercise, and we look at fixed versus variable costs. So we're going to come back to that. And then when you're done, you sort of have to put it all together and give it a smell test and say, does this make sense? And is the result acceptable? I will say what we're talking about right now is an operating budget, because that's the one that I think we're going to have the most exposure to and the concepts that'll be most useful to us. But there are 3 types of budgets. You have an operating budget, you have a cash or a working capital budget. So let's say you're like, you saw those financial statements. Remember we talked about current ratio, or, you know, my shortfall in short term, or my current assets were $281,000 less than my current liabilities. Cash budget, how am I going to pay that? How am I going to pay for that? So cash budget is basically about how am I going to bring in enough cash to meet my needs going out. That's not going to happen from operations, or if there's a timing issue or whatnot. You know, in our environment, if we're not getting very many, if our private pay revenue stream dries up, remember the private pay is a source of float for us, right? Because we get paid that money at the beginning of the month. If our private pay census goes down, we lose that beginning of the month. So we might have to look at like a line of credit or something like that we draw down to keep up with our expenses and then pay off when revenue comes in at the end of the month, right? And maybe over time we eat that up. But that's what a cash budget's about. The other thing is a capital budget. And typically that happens when you're doing a major renovation or building a new facility. What's it going to cost to build? What's our ramp up time look like? If I've got a 60-bed facility and I'm building 100 and I've got 50 residents in my 60-bed, but I'm building 100, how do I ramp that up so that I'm covering the cost? And, what's my process? So looking at setting an expectation for that in the context of. All right, so let's talk about budgets. I'm going to start. This is actually in your materials. This should be the first page in that budget PDF that you've got. I always start with revenue because when you think about it, census really drives a lot of stuff in our buildings. So the biggest thing we have to look at is what's our census assumption going forward, right? So what I've said is, I basically said, I'm going to start with December 31st of 2020. Here's what our estimated actual is going to be. And the reason I say estimated is this: you don't typically wait until you're in the year you're doing a budget for to do the budget, right? So your timing would be, you might do this in November, October, November, somewhere in that. So you project out what you think 2020 is going to look like so that when you start January 1st of 21, we've got a budget in place already, right? So your timing is typically a couple of months or a month before you. So we might look at this and say, well, Medicare, there are two components to revenue, right? There's your rate and there's your census. So what we might say is for Medicare, our rates are going to go up by 2.4%. Our census, we expect to go up by 370, or whatever percent that is. So when you look at that, based on that, we're saying a 2.4% rate increase and 370 additional days. Our budgeted Medicare revenue then is $533,600. You basically factor all of those things in. 1,600 days times Medicare rates plus 2.4% is kind of where you're at. Same thing with Medicaid. We think there's probably a rate increase at July 1st of 2021, which is midway through calendar 2021, which is what we're budgeting for. We think we're going to get a higher quality of care fee because of the provider relief funds and all the stimulus that we've got, and the higher Medicaid rates that we got here, right? That ultimately results in a higher quality of care fee, which ultimately results in a higher Medicaid rate. So it kind of goes around in a circle. And I basically said, the assumption I made was in 2020 that our census bottomed out because of COVID. And we're expecting a 13% ramp up during this year to get all the way back to where we were, and so on and so forth. We might raise our room rates for private, but you can see the assumptions that we're making. We're documenting what those assumptions are. You know why you document what the assumptions are? Because I don't care how good you are, your budget will be different from your actual, and you want to be able to explain what those differences are down the road. It's important to know what you were thinking at the time that you built your expectation. Okay. So ultimately what I've said is we're thinking we're going to have a 20% increase in our revenue based on a 13% increase in census and a variety of increases in our payment rates. But now that we've got census sort of worked out, then we're going to get into expenses. Okay. So we're going to start with salaries. And this is salaries at the top, and this is other expenses at the bottom. But what we basically say is, here are our salary expenses for 2020 for each one of these levels. These are the FTEs that we have. Remember, full-time equivalents, that's based on 8 hours a day or a 5-day week. So we've got our actual FTEs, and we're basically saying for our budgeted FTEs, our volume is going up. So we think we might need half an FTE for laundry, so add a part-timer there. For dietary, we might upgrade to a full-timer, add a part-timer there because that volume is going up 13%. We think that's the trigger point where we might need more help with those two departments. Remember, we talked about those being kind of mixed costs, not pure fixed, not pure variable. That's the thought process, and that's how you look at it. You know, the expected raises we think are, you know, I put 3% in there. That's kind of that's a pretty good raise based on where we've been in the past. But what we're basically saying is we paid some pretty good raises in 2020 or some additional bonuses and COVID pay and sort of that. We expect that we're going to have to sustain some of that. So overall, that salary expense is going to go up about 3%. But maybe we didn't have, you know, COVID bonus payments didn't start January 1st. They may have started in April, right? So we lost part of the year in that estimated actual period. So we're saying 3% increases in the rates, about a 1.5 FTE increase in our personnel. And so salary expense, we expect to go up 4.6%. Again, based on census, based on what we know about the environment. Everybody see that we're trying to think about the only thing I expect to change on this line and so on and so forth. All right, so the next part of this is our other expenses. So start with our rent expense, maybe. Rent, property, insurance, taxes, and depreciation. There might be a 5% escalator in our rent agreement that says we're going to increase your rent payment for 2021 by 5%. So that may be something that's agreed on. Benefits expense. You know, if our salary expense goes up, our benefits expense goes up because most of that is Medicare and Social Security and payroll taxes. Workers' comp and health insurance wouldn't go up as much. We generally build some conservatism in and say those travel together. You know, the quality of care fee, we talked about that one going up. Our liability insurance based on COVID risk. Carrier, we might call our insurance carrier or our independent insurance agent. They may say, yeah, we expect liability rates to be up 15% this year. We know natural gas costs are going to go up in 2021, right? The market it's good for the economy. It's bad for the utility, right? You know, for repairs, we might say we expect a 15% increase in our repairs expense because we didn't focus a lot on making repairs. We were trying to keep the wheels on and people segregated and some of those kinds of things. So, you know, our rehab costs, our ancillary costs, if our Medicare days go up, generally our rehab costs go up. So you kind of see how everything in here is sort of built around, let's think about these elements and what we expect to have in the future. You think about it in terms of census, you think about it in terms of environment. This is actually, I hate to use the phrase, the fun part of accounting, but thinking about that and then trying to translate that to dollars and cents, right? And remember, one of the things we talked about in financial management, almost in the first 2 minutes of the day, were the ability to think about changes you want to make to your operation and what impact that might have financially. This is an illustration of that, kind of that process. Okay, so we've got our pieces all kind of put together, right? Remember I said we have to do a smell test? We have to do a smell test. So what we're going to do is we're going to take our actual 2020 $593 profit there. That was a very good year. And we're going to look and see, you know, we're going to take our revenues from our revenue budget. We're going to take our expenses from our expense budget, and we're going to say, in the end, is $256,000 or about a 7% margin. Is that reasonable? Well, if it were a big negative number, I would say the owners or the board or somebody is not going to buy off on that. And if it was a big positive number, I don't know that I'd do that to myself as an administrator, you know, set a bar very high that I want to try, that I don't think I can achieve. So when you're looking at this, you're just basically saying, once I put everything together, does it make sense? And I think I'd be hard pressed to say that doesn't make sense based on the, based on the assumptions that we've made. So that's the first part, which is setting an expectation, right? So a couple of things about that. It's not all on you. It's not all on the accountants to do this either. When you do a budget, think about those expenses, think about those revenue assumptions that we made. We think it's generally a pretty darn good idea to get a lot of people or a few people involved in that process. You know, the reason you involve anybody in a process is two reasons. One of them is you want their expertise, and the other one is you want their buy-in. Because what happens down the road is you're trying to keep people accountable for achieving the budgets. If you say to your dietary manager, your food budget is $9 a patient day, and she wasn't or he wasn't involved in setting the budget, what are they going to say when it's $10 a patient day? Well, you didn't ask me if that was reasonable. It's not my fault. It's your fault for setting an unreasonable budget. So you get the buy-in. That doesn't mean you have to do what they tell you, but you have to involve them in the dialogue. So that's a piece of it. The other piece of it's the accountability on the back end and sort of understanding why things are different than maybe what we budgeted them to be. So this is July. And so what we've done with July is we said, we've taken this budget for a year and now we've broken it down into those little slices again, like we're prone to do, right? 1 month slices. And so here's our budget for July. And here's what we actually achieved in July. And you sort of look at this and say, well, our Medicare revenue was $2,700 ahead of our budget. Well, in my mind, that's not enough to even have a conversation about. But it might be that we hired another MDS coordinator with some more experience and maybe paid a premium for them. And as a result of that and that person's relationship with the physicians, our Medicare lengths of stay went up by 2 to 3 days. So maybe that's something. And part of that's validating, yes, I made a good business decision, right? Medicaid, we're recovering our census at a better than expected rate. Our private pay, you know, it might be that when our census is down, we basically said we've got all these semi-private rooms. What if we elevate our private pay rate to 185 if those private pay people want to be in a private room? So maybe we actually grow both our private pay census and our revenue by doing that. So a way to differentiate, take advantage of the capacity that we've got. Our provision for bad debt, basically our write-offs went up. Maybe we had to let somebody go in the business office because they were, putting checks in their pocket, right? Or something like that. So, you sort of look at that and say, these are our differences, and let's make sure I understand why. If we understand why, then we can make those corrections or explain those variances. Our facilities cost actually went up, and maybe that's because we had a rent increase due to higher Medicaid. We might have had a census escalator in our rent agreement or something along those lines. And you sort of look through here, or we had some unforeseen capital investments that we had to make or something like that. Benefits traveled with salaries. Our plant, let's say that we had an unseasonably cool July, so our electric bill wasn't as high as it was the previous July that we kind of budgeted for. We thought to get our census growing back, we might invest in some more social services, some more engaging type activities, that sort of thing. So, but you can see the thought process here is looking at those differences and not getting too caught up in the little ones, but just understanding where this is the thing we assumed was going to happen. This is what actually happened. So then the issue is, as you look at those things, are there things that we can change? The food cost is one that we showed going down by 7%. Maybe we made a change in our dietary vendor, and they said basically we're going to change your cost, but we went away from a menu-driven food service model, and maybe that's having an impact on our on our census, and we think maybe going back to that, is it just looking at and thinking critically about your expenses and what happened in your facility. And I got to tell you, I know accounting isn't very exciting, but this gives you an opportunity to really reflect on your performance, because you basically put in terms of numbers your activities. I mean, this is a way to measure, just like resident satisfaction surveys are a way to measure, or quality measures are a way to measure. This is also a way to measure. Okay. So that's budgeting. Just a couple of thoughts I want to leave you with. A couple of reminders, and this really is more, this is not test stuff. This is things that I've learned as I've seen people make mistakes, or seen things go wrong. I'm one of those guys that has to make mistakes myself to learn from them. But one of the things that you learn is, and I said this early on, don't pay vendors from statements, only from invoices. Never get in the habit of entering statements in your systems. Know the difference. Make sure the people that are posting those vendor invoices know the difference between a statement and an invoice. You should never post a statement in your system. You lose the source document if you do that. You lose an opportunity to have a conversation with the vendor as well, to make sure that you're being billed correctly. I think minimizing your cash and checks on hand. Remember, those are some of our most sensitive assets. I would recommend that if you get a check in, that you put it in the bank that day. Let's get it in, let's get it posted, let's get it deposited as quick as we can. We don't want that stuff sitting around. It's subject to shrinkage, just like chicken in Arkansas. Hire a company to process your payroll. I tell you, because I've done a whole bunch of these Paycheck Protection Program loan forgiveness applications. One of the things I've learned is there are some really good payroll companies out there. If you're doing payroll yourself, there's just too much to it, and there's so many slick systems that have great, robust reporting capabilities. We're even seeing some payroll systems where there's an app involved. If you have an employee that needs to call off or call in, they can actually go into the app, find their replacement among your employee pool, and not involve the scheduler in that process. And it even goes so far as to look at that and say, if this employee covers your shift and their planned shifts for the week, they would be in an overtime position. And if that's the case, you need approval from your scheduler or whoever's in charge of that. But the sophistication around some of those systems is really huge. And frankly, in some cases, paying a couple of hours of overtime as opposed to having somebody call off and scrambling around to find somebody to cover a shift might be worth it. The technology out there is unbelievably good. Plus, those companies maintain the tax tables and all of that stuff, so you don't have to worry about whether you got an update or whatever. It's a good idea. Considering positive pay, the banks don't take a lot of risk. And I'm not criticizing banks, don't get me wrong, but the banks don't scrutinize checks that come in the door, right? They process whatever comes in. Positive pay is a process where on a periodic basis, you submit to your bank a list of your check numbers and the amounts of the checks, and they make sure that the check's cleared for the amount that you said they should. It's a pretty good control. And it's usually pretty inexpensive. Now, there's a higher level of service where you submit your check vendors, and they actually check the vendors as well to make sure that the payee is who you thought it was going to be. That's expensive, or can be expensive, because that's a more manual process. But if you've got a problem, it may be worth looking at. And finally, I hope I set out as an early objective to basically say, we're not all accountants, and the people in my profession are really pretty good at classifying transactions and booking things correctly and getting the debits toward the window and the credits toward the door, all that good stuff. But accountants aren't known for their communication skills and, the ability to deal with some of those things. It's not that we don't want to talk to you, it's just that we're shy, right? So if you have questions or something in your financial statements doesn't make sense, or you're thinking about making a change to your operations and want some help thinking through it, there aren't any dumb questions, right? You have to understand that you know your operation better than an accountant. So don't be fearful of challenging them. We are as a profession, we're in the information game. And if you don't understand what we've put in front of you, we haven't given you information, right? We've just given you a pile of paper. So make us do our part. Hold us accountable for it. Questions? I'll be around here for just a couple of minutes, but that's all I had on my agenda for the day. So I'll be around if you guys have questions or if you have a game to get to. I understand.